A very good morning to you. It's Friday the 30th of May, which is, Scotty Byrne, the last trading day of May.
Absolutely.
And what do we do at the end of May, Scotty?
We can very well sell in May and go away. For extend the same, return again on St Ledger Day, September the 15th, but there we go.
And to let everybody know what St Ledger Day is as well.
Horse racing event. So that was the first kind of horse racing event of the autumn season.
Right.
So all the blue bloods used to come back from their country manors and all meet up and race to St Ledger with their thoroughbreds. So yeah.
And was it you that invented the phrase?
Yes, I must admit, 1862, myself and a friend were sitting at a coffee shop having a chat, thinking this would be a good idea to have a bit of a summer break.
Yeah, why don't we just tell everyone to just go away at the end of May?
Absolutely, just go away, just go away.
Right, let's have a look at what's coming up on today's show, the last one of May. Scotty, run us through what you see coming up on screen eventually, because the guys still haven't fixed the fact that it comes up so slow.
So we've seen overnight a little bit of weakness in China, and particularly after Scott Bessent said that talks are stalling. Obviously, the price action yesterday was not particularly positive.
Sorry, no, I mean what's coming up on today's show on the...
Oh, what a Wally. I'm never going to get invited back. Right, overnight action. Overnight action with me and Rich. The opening bell, which I'll try to ring a bit louder today. Fast markets with Rich and I, and then 8:35, investing experiences with Aaron Bright and myself. 9 o'clock, all sessions opening bell. Trading experiences with Aaron Bright and Martin Harris. And then Dr. Jim at 9:35 with Rich. Who is Dr. Jim?
Dr. Jim Schultz is probably Tasty's secret weapon.
Wow.
Because everybody knows Sosnoff and they know BAT, but Dr. Jim actually does all the hard work of teaching everybody about options.
Wow.
So he was a professor for 6 years, and now he's kind of leads the education front. So we've got an interview with Dr. Jim coming up today at 9:30. Now, there's a little rumour we might even sneak a 5-minute interview with Angeline in live from Milan.
Incredible. That'll be something.
So we'll hear all about her stories from the week.
Yeah, I hope it's a bit sunnier than it is outside here at the moment.
Ugh. Right, but we've got a special edition of Overnight Action today because Scotty's given us a little write-up. So let's go straight into that.
So this was the write-up for yesterday because we were looking to a breakout. So this is something I do every day. In the comments, you should be able to see a link to this. It's free subscription if you want something to help you to get set for the US market in particular. So we do a little run through of the factors overnight. We've really tried to recreate the kind of things that Rich and I used to write for customers.
That's exactly it.
Back in the day, so that if you don't have the time to look at the paper, or you don't want to, or you just like a bit of a human touch, that's that first paragraph, and then we're looking at what to focus on a little bit lower down with the stocks we think are going to move. Obviously, because this was written for yesterday, this is all about Nvidia and peers.
So run us through what you're thinking about putting in today's then.
So for today, I think it's a bit of a split move overnight. I mean, Fridays, as we know, are very difficult to get going anyway, because of the natural kind of human cautiousness. But Japan, a little bit softer, but again, as I said to Rich, interesting to see CPI still on an uptrend. Industrial production month on month was small better, but 1 month forward had a huge jump. I don't know if that's stockpiling for pre-tariffs, but that's just showing the underlying strength of the Japanese economy. And I'm not about to say that we're about to get in a pickle with rates, because obviously that's not appropriate, but that's definitely something we should still be watching. That price action in the US was pretty brutal yesterday. And as Rich and I were discussing before this, if you've got strong conviction views on stocks, you don't have to fiddle with them into earnings, because that's generally the worst time.
Yeah.
So if you remember, Rich on Wednesday was thinking about his Nvidia position, maybe trim it, maybe not. Actually went away and thought about it. And sometimes it's better to let you have something in the market, some kind of skin in the game, where like you feel you've done something that you can react to.
That's it.
So that's quite interesting. And then overnight, China, a little bit softer.
Oh, well, hang on, Scott. You give the guys in the gallery the cue for overnight action, and they'll play you a little intro.
Oh, well, overnight action then, please, gents in the room.
That's it. The thought of some overnight action for Scotty has got him all hot and flustered.
Absolutely right. I think Interesting yesterday, the price action, which fed into the US session initially, was weak consumer spending data at 1:30. That got kind of lost in the melee of Nvidia numbers. Then that weak housing number as well at 3 o'clock, that really sent us into a bit of a tailspin, which brings us back to...
You can see that on the graph, I would imagine.
Yeah, exactly. So you can see that big sell-off from about 3 p.m. onwards as well, a little bit closer in.
So those that are just tuning in, tell them what sent it up into the sky in the first place.
So the sentiments on Nvidia, as we know, or hopefully know, I think the Mag 7's 32% of the S&P.
Yeah.
So when you have a company like Nvidia, and it's clear from the last few weeks that the whole sentiment around AI has gone back to positive after all the shocks for some of the competition space. So you had a big jump higher in futures.
That was the first bit there.
That's right. Everyone wanted to get involved in the market. Remember, 59.50 on the S&P. We're talking about is still a pretty strong resistance for the last few weeks.
It was the court ruling really that drove that.
Yeah, that's right. Stop, slow, or pause the tariffs, and Nvidia on top. You had a great little cocktail for a good run, certainly
right
for yesterday.
Up until the market opened.
And then the market opened, you had a little tick up, and then you just saw sellers. I mean, Nvidia opened up, 6.5, closed up 3.5.
Yeah.
So whether that's just natural caution from people, a lot of people like to buy stocks before they report, then sell them on the day. There could be a bit of that. But I mean, that's a big move in a big stock. And then you can just see the progressive move lower, then accelerated after the data at 3 p.m. And we had a little bit of a rescue into the close. But if you're just looking at the charts and looking at sentiments, that's pretty negative for price action, or certainly for psychology, if nothing else. And then Scott Bessent, it was quoted in Bloomberg yesterday as saying that the talks with China have stalled, and Xi and Trump need a call, and I would imagine that the mood he's in after having a court blocking the tariffs. Let's hope that call happens next week, not today.
Well, but now the court has blocked the court decision, and that's why part of the reason that we came off yesterday, because of course, as we said on yesterday's show, there was not a chance that Trump was just going to roll over and let some court that we'd never heard of tell him that he couldn't put tariffs on. So that was done and dusted within a few hours. And now we go into today, and everything we're seeing is just a little bit more
cautious.
Yeah, there's your Japanese CPI to go through, Scotty.
Yeah, so as we've spoken about, that if Japan are going to get pushed into having to force rates, I mean, I think basically the country owns 52% of its own bond market. So you're in a rather unfortunate situation where the phrase negative spiral can come into play, because at some point, to see you've got control over your economy, much like the US, you've got to start thinking about raising rates. You look at that CPI data, it's creeping up again. It's not flying, it's not roaring away, but it's just, I mean, on the year-on-year move, flat, but those monthly moves are picking up. Industrial production's quite interesting, because that was just a bit weak to consensus, but then you've got 1 month forward industrial production, which actually had a big spike. So
and retail sales better as well. So all in all, Japan doing well, but the number that was important yesterday was, as we see here, that you mentioned in the US, right? Yeah,
that's right. It was. Actually, that's the calendar for today. Actually, Rich. I don't know.
No, this is yesterday. So we had initial job.
Oh, sorry, Cobb. Sorry. See, it's lucky you know what you're doing. So, yeah. So look at that last one at 1:30, just above the South African one. That real consumer spending. That's a big drop.
Yeah.
Especially as you're coming into holiday season, which was really unhelpful. And then the pending home sales. I mean, look at that, minus 6.3 month on month. That was a real push lower.
Yeah. So quick look at what we've got coming up today then in that PCE. Take us through the expectations, because they are looking for a flat core number, aren't they?
Yeah, this is, I mean, as we know, and as you actually instructed me years ago, this is the core metric of the Fed.
Yeah.
So that's why they're happy to wait, because it's not running away. But then the issue is with the core data, that excludes food and energy. I mean, who eats and who puts fuel in their car, right?
Yeah.
So yeah, I think the component parts of that, generally on these pieces of data, the component parts within there. So if there is a tick down in the shelter price, which is rent, which is potentially why there's a forecast for a flat month-on-month number.
Yeah.
And then if expenditure is, still going up, a little higher up that table there. So again, the year-on-year number, we can see inflation has crept back in. It could be psychological because the tariffs are real, because if you're a company who's about to get hit by a tariff, you're going to raise prices first because you can always lower them later.
Yeah.
But yeah, I think the core number is going to be
2.6%. Sorry, when I say flat, I mean that the core PCE is expected to be the same as last month. The actual month-on-month is expected to come in at 0.2%. So we've got, certainly inflation's still there, but will it come in higher than expected? That is going to put bond yields higher again if that does happen, just as they're starting to come down. So as the courts blocked that, as the court blocked the court decision yesterday, and we were back on and tariffs could be applied, then you actually saw the 30-year yield come down again. So that's interesting, that the market is clearly saying if we blocked the tariffs and they didn't come on, the economy would be so strong that yields have to be higher.
Yeah.
But if the tariffs go ahead, then yield can be lower. So
I think that that 30-year yield, I mean, if you got interest rates in the US for 30-year mortgage, last time I checked, was 6.86%. So if you think rates are bad here, I think the move, it's good to see the 10-year below 450.
Yeah.
But someone explained to me recently, it's not so much the absolute rate or the yield that the 10-year is at, it's the speed at which it jumps from one area to another. Because as we know, a lot of equity risk models have the 10-year factored in because it's the most liquid, most freely traded. So when that starts wanging around like it's a 2-year yield, that's what gets people just as nervous. So rather than the absolute number. So yeah, look, there's some interesting moves.
We can handle that. Like
up to kind of 450. That's the anecdotal. That's the pain point.
And that's what going through 450 on the way to 460. That would be the concern, which of course could happen if PC suddenly comes in higher today.
You can't rule it out.
But more likely we'll see that in the coming months.
Yeah.
So where do we start? I think we probably go into the headline, front page of the Financial Times there. Let's take a quick look at that. Because the FT is leading with a story that sounds as boring as you could possibly imagine, but it must be leading with it for a reason. And that is a foreign tax provision that was hidden in the budget bill, the big, beautiful budget bill. And that is, it's called Section 899. And Section 899 was hidden on, page 147. And it allows Trump to start taxing foreign investor income from treasuries, from stocks, and somebody's gone as far to call it a market spooking event. It's not really moving futures this morning, which we'll take a look at in a second, but it's this continual concern that foreigners are going to be punished no matter where it is, on whether it's selling goods into the US or whether it's on their investment income, coming out of the US. So it's worrying, but the FT summarised at the end that surely this doesn't get through Senate. But if it does, then that's a real worry, because Section 899 would increase taxes on dividends and interest on US stocks and corporate bonds by 5 percentage points every year for 4 years. So your taxes on dividends can go up to 20%. It also could impose taxes on sovereign wealth funds, which are currently exempt. So that's the top story in the FT this morning. What is that doing to the futures market, Scotty? Let's zoom in on that.
They don't. I mean, that was looking at them sort of an hour and a half ago. There doesn't seem to be a great deal of change. Germany's probably rallied a touch. Vol's ticked up a little bit, but I mean, even the gold price is drifting. I think it's a real Friday end of month sort of. I mean, if you actually think at the end of each month, we're saying what a month that has been. Is there going to be another one like it? And we
Yes.
seem to have. But even that's a short week this week. I mean, it seems to have been exhausting with the blocking tariffs, and then they're back on, and so on and so forth. So anyone out there who's finding it tough trading conditions at the moment, you're certainly not alone. But yeah, I mean, industrial metals not really moving. It's a real hard one to sieve anything out of. I think with VIX, if I had to pick VIX back above 20, just probably shows you where psychology is as we come into the US this afternoon. But as we mentioned earlier on, it is month end today.
That's right. Yeah. So we'll actually come to that after the 8 o'clock hour. We'll do the market open. And then Scotty, one of his many hats, one of the 37 hats that he had at Credit Suisse, was king of the rebalance. So Scotty's going to explain to you after 8 o'clock exactly what it means at the end of the month and why sometimes moves don't really make sense until you actually know what's going on underneath the surface.
Yeah.
So that's coming up. Yeah, let's do that about 10 past 8.
Sounds good.
Right, good morning to you all this morning. So who have we got in? Maturin is in the house. Andrew McKelvey talking about the M&G partnership with Daiichi. So we'll take a look at that. They talking about buying 15% of the company in the market. We got Funky Gibbon, Julian, good morning. Carlo, good morning. Shrimp Fred and Jugger. Now that's all the usual crew that we get in the morning. What about if this is your first time? What about if you've seen one of the YouTube shorts that we filmed this morning of the guys in the gallery? If you want to know what the guys in the gallery look like, go on to our shorts page on YouTube there. So on the YouTube page, go on to shorts and you will see in the break that we're about to take, producer Phil and Big Dom. Now, Dom sent me his portfolio yesterday. This boy has done well in May. He has got a real portfolio there. I'll run you through that in a second.
Superb.
And also Cam that you don't hear too much because this is the guy that taps away in the background and does all the hard work. He's about 70 years old and he looks about 25. So you'll see. Actually, I'm sorry. Let's do a poll on what Cam's age really is.
Poor Cam.
There's poll of the day. What is Cam's real age? You'll have to go into the short section to have a look. Right, so we're going to go to a quick break before we come back. Then we're going to have upgrades and downgrades, if there is any. And we are, of course, doing guess what the chart is. Right, we're doing good. Guess the chart. And today's clues is, it is a stock. Yesterday's was a commodity. Let's see if today's a bit harder. Here it is, coming up. Chart of the day. Guess what it is?
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante. Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Right, here we are. Welcome back. The 30th of May, last trading day of the year. We've got the FTSE looking up about 15 basis points. We've got S&P down 22. Last trading day of May. Is it time to sell in May and go away? That is the question. And you don't come back until St. Ledger Day. So September, do you just take the summer off investing? Well, we don't want you to take the summer off watching the show. So, Scotty, what are other alternatives for your investments at the moment? If somebody like Dom in the studio, who has some incredible stocks there, he's got Tesla, Nvidia, Amazon, Nike, Alibaba, Microsoft, and the Vanguard S&P, and then electric vehicles ETF. So you would say quite heavily weighted towards the US, right?
Yeah, that's true. I think, as you and I remember, unfortunately, it's not something you can always do on the trading floor of an investment bank, but selling out the money calls, I think, is a great strategy for over the summer, because you get the time, you're still collecting time.
Yeah.
You're almost, I mean, again, it's your levels. You could pick more than one level for you to go at, but it's quite difficult to really see a big change in the narrative over the summer, because at the minute we have the tug of war, don't we, about the tariffs and growth and so on and so forth. I mean, look, the Fed have basically said no rate cuts until at least September, right?
Yeah.
So you're just playing with market noise, and that's where you can make a bad decision. That's where things like options can just be such a time saver.
Yeah, time friendly.
Yeah, a time friendly. So if you have the position, if you lose a little money on the options, then you'll still make your money out of your stocks. You get the luxury of time, which over the summer is a good thing to have, because markets do just barely really move in more than not a 3% channel, really. There's volatility, but the real kind of week to week and month to month moves, that's huge.
That's it, isn't it? I mean, what would be our guess for May? I guess we must be...
I mean, as we said out there, for everything that's happening in the bond market and stories like this in the FT, this is what a lot of people in fixed income thinks, that stock guys are crazy, because you've got S&P, 6-7% off all-time highs, whatever it is at the moment. So yeah, I mean, it's a real struggle, and I think generally decisions you make over the summer are not the right ones, because they're reactive rather than a proactive one, which you can take before the summer.
Definitely. Right, Mr. Andrew McKelvey, we got the story in M&G for you. So, a strategic deal with Japan's Dai-ichi Life. We're looking, so this is an RNS out from M&G. It's formed a strategic partnership with the Japanese life holdings company. and it expects to deliver at least $6 billion of new business flows for M&G over the next 5 years. The partnership's also expected to deliver $2 billion in new business for Daiichi, it said. Now, just trying to get the part where they're talking about buying stock in the market, Andrew, and that is here. So, it is looking to take a 15% stake in the British insurer, that's punchy, isn't it?
Yeah, and that's not a liquid stock either, if they're going to do it in the market.
Yeah. Yeah, let's get that in the RNS. Now, while I'm looking for that, Scotty, run them through what my frustrations were over the break looking at that chart.
Yes, as Monkey Man rightly spotted, very, very quickly, and rather embarrassingly for us, a lot quicker than
much quicker than
we did. It was a chart in Vodafone, which, as we know, Rich, I think that's been a hobby horse of Rich's for quite a long time. Obviously, I speak to him a lot. And it can be one of those things, it's almost like the classic mental block where if you talk about something so much, then if you're presented with that kind of illustration of it, it can almost be the hardest thing to spot because you're running through your mental Rolodex of stocks. And we saw from the price, because it seems like most things in the US have got 3 figures.
Yeah.
So we said it's only got 2 figures on the price.
They made it especially hard because they missed off the currency and they missed off the time period at the bottom.
But that's why you're you, right? They like testing you. If they're going to make it easy, anyone could do this job.
Well, they got Monkey Man. So Monkey Man, if you look at the chart there, you see that very bottom tick, like the lowest that the price could possibly ever go. That's where he bought stock.
Oh, that little wick.
63 pence.
He was sitting on the bid.
Yeah, Monkey Man, tell us, were you sitting on the bid at 63, or did you lift the offer? Tell us that. So we're about to open. We've got the London Stock Exchange, UK stocks about to open. Scotty's going to pick up his bell and he's going to ring it.
Goodness me. This is nerve-wracking that one day I'm going to break it.
Oh, if you break that, there's a bonus.
Right, okay.
That would make great viewing. Right, there we go. So the FTSE up 15 basis points. We're going to get these stocks opening shortly, and it looks like British American Tobacco is leading the charge. But what is M&G going to do this morning? I don't think I've got it on my watch list, so I'm going to have to add that.
I don't think investment trusts are generally the watchword of your stock list.
That's right. So, right, run us through some of the big moves, Scotty.
So we've got Flutter on the move again. Interesting. That's actually been a mover a couple of times this week, I've noticed on the list. BP as well, after we said how much of a laggard it was, just not going anywhere.
Yeah,
that's
how much is that one up?
That's up 1% as well. That's obviously thumbing its nose at us. Centrica again up 0.75%. So that's a little bit of action in the energy space, really. BATS up almost 70 bips again. Land Security is up 50 bips. So again, much like looking at this on Wednesday, there's no real early sectoral theme.
Yeah.
It's much rather, it just sort of seems individual names, a bit of follow-on from yesterday. Watched of Switzerland, that's quite interesting. I did see there was a headline in I think it was either the Times this morning or another news line I was looking at, where more people are buying used Rolexes than new.
Right.
Maybe because of the tariff. So
do you prefer used or new Rolexes, Scotty?
I prefer used, really, because it's got a bit more character, just like me. You know, it's easy to go in a shop and well, actually, saying that though as well, a friend of mine, his wife actually works for Rolex, and she said that on most models that the lead time is still like 6 to 12 months plus.
Wow, that's amazing. Not on my Casio, it's not.
No,
I can go into Argos. I reckon it'd take me about 7 minutes to buy my new Casio.
Yeah, exactly right. Exactly.
1999. Right, let's have a look at Vodafone then. There it is, down 29 basis points. But the important thing in Vodafone is next week, I'm going to take that button off you, boy. Next week in that stock, it does go ex-dividend on Thursday. So next week, 2 pence dividend. So Vodafone is really 74.6. That is the great value with this stock, because twice a year, it goes down 2 pennies and gradually works it back up, which is always a funny one because people say to me, oh, Vodafone hasn't done anything since you talked about it at 70p 12 months ago. Well, it has, because you've had 6p in dividends. So that's the nice little, the gift that keeps on giving.
Yeah, the extra kicker, yeah.
Right, so the best performer of the day, M&G up 5%. We're going to take a look at that one now. But Reckitt Benckiser back above 50 quid as well. Did I get the and? It does work, yeah. There we go, up 6.6%. This one's interesting because it's got a huge divvy yield, and look at the way that it sold off there in April. Oh, what have I done there? Selling off in April on the tariff news, and what an incredible comeback.
Yeah.
What's the difference, Scotty? Do you know much between M&G and some of the other similar companies in the industry?
I don't know. I mean, that's a properly venerable stock on the exchange. I don't know about their business model so much. I think the problem is, which is something that we can also look to touch on the month-end stuff in a few minutes, but unfortunately the asset grab by some of the larger titans of the fund management industry has left these guys basically doing a little bit of kind of more specialist work. So if you're setting these amongst its peers, then their value should be just selecting things like investment trusts. That's how they always used to actually attract their money. So if you think nowadays, lots of people like to focus on a fund of hedge fund investments.
Okay.
That's what they used to do years ago in investment trusts. So you would give them your money and they would pick the best investment trusts for you. So I suppose investment trusts were almost like early day ETFs, really.
It's an interesting one because I had lunch with Wisdom Tree yesterday. And the difference now, the popularity of that ETF world is just incredible. And they presented 2 ETFs to us. One which was an interesting one. It was a new take on the 60-40. And what they do is they put 90% into stocks, right? Then they put 5% into bond futures.
Okay.
But because that's on leverage, then you get the same as a 60% weighting of bonds.
Wow.
Right?
Okay.
And they use the collateral to pay for the leverage. So there's not a funding cost.
Wow.
So what you're actually getting, instead of 60-40, you're getting 90-60.
Okay, that's
so
interesting.
You've got 90% in equities, 60% in bonds, and then the other 50%, they argue that you can put into gold or maybe copper, or you can add to the diversification. So I thought it was a really interesting idea. And then the second one, that I actually said to the woman afterwards, it says, will you please come on the TV show? Because it was the European Defence ETF run by Wisdom Tree.
Yeah.
And what they noticed a year ago, right?
Thank you, Poppy, as well, which is in the comments there. That's the asset management arm of the old Pru. There we go, yeah.
I'm sure Poppy's probably worked there in the past as well, having worked in most of the... it was MAMS.
Oh, yes, okay. Yeah.
Which, of course, is Merrill Asset Management, wasn't it?
Well, it's now BlackRock, wasn't it? So Mercury was how it was.
Mercury, sorry.
Mercury Asset Management, yeah. Yeah, they had the office opposite Barclays on Lower Thames Street.
Right.
Yeah, now part of BlackRock.
I
think, look, I really do think anyone who you can have on that can lift the lid on how some of these ETFs work, because I'm somewhat old-fashioned where I think that these leverage ETFs are going to be a potential issue.
Yeah.
But again, at the same token, if you can simulate, it's like anything.
But it's not leverage in sense. It's not a leverage ETF.
No. I just mean that I think it will be very interesting for her to explain the difference between what they're doing as regards a sort of a safety vehicle with amplified returns, as opposed to sort of leveraged ETFs, which get, rightly so, extremely bad press. So I think it's a great thing to differentiate to people, and might help you choose some of your investments in the future. So I think that'd be really interesting.
Right, I'm just trying to get up the... here we go. So this is the Wisdom Tree European Defence ETF. So what they noticed a year ago was that all the defence ETFs were around were mostly focused in the US. And they correctly predicted, which is incredible, from October onwards, that there was a chance that Europe, down to NATO, down to Trump, that if Trump was elected, then there was going to be a potential for a lot bigger spending from European countries, and therefore European defence names. So they put together this. They launched it on March the 11th.
Oh, wow.
And you can see here from, well, let's not take the lows of April, but basically 20 quid, it's up 30% in the last, what's that, 2 months?
Yeah.
Up 30% in 2 months. And they take the weightings, instead of saying, right, Rolls-Royce can have a 12.5% weighting, because it's not entirely a defence company, then they will actually put a smaller market cap, a bigger weighting. So Rheinmetall has a 12.5, well, now over 13% weighting. And the likes of Leonardo, British Aerospace obviously is heavier in defence, but something like Airbus will only be 6.5%. So you get a true weighting of 70% revenues of defence companies. And, you know, really interesting the way that they had the foresight to actually notice that this was going to be a thing.
Look, it's really well timed. I think it's a great example of if you can have the quiet time for thinking and actually extrapolate out. This is what we're saying about if you're trading over the summer.
Yeah.
If you've got time to think and just draw yourself away from the screen for a little bit, you can actually, you can come up with some great ideas. And that's, absolutely. And that's why sort of a lot of the time as a proxy for Germany and for that whole defence trade, I should look at Rheinmetall because it's not super liquid. It's obviously more liquid now because its market cap's probably gone up by 50% or something. But
oh yeah, more.
Yeah, it's a great one sometimes for picking the odd single stock for a proxy, but then to actually get the proper uplift across that sector, you're far better using those sorts of institutions who really do the work and think about having, as long as you understand what they're selling you.
Yeah, well, that's which is obviously in all the notes and everything.
Yeah.
But you can see here, if we look at the likes of Lockheed Martin, in the same time period, Lockheed Martin is up about 7%.
Just about.
6%. So, you know, you've got 30% in an ETF in the same sector, and the likes of Rheinmetall's up 50% against this thing, you know, that's up 7%. So, which you can only imagine would the cash flows would continue in that terms as well.
Yeah, absolutely. I mean, it's all money flows, right?
Yeah, because if you've got the US government trying to balance the deficit, then they're going to bring defence.
Well, and they're also looking to withdraw from international conflict and spend it more domestically.
Yeah.
Then, as with Trump and his golden dome, that's not his hair. That's just his his defence system. But yeah, listen, it's as the US becomes more inward looking, then yeah, it makes sense. And look, and the stimulus package as well was obviously a huge game changer for some of the defence stocks in Europe as well. But yeah, look, as we were saying on Wednesday, right, the world is a less sure place.
Definitely. Right, so yeah, that was the Wisdom Tree Defence ETFs focused in Europe. Then let's have a look at commodities. So we've got, Scotty, run us through some of the big commodity moves there.
Interesting, oil back on the drift again. It seems to want to hold $60, but again, with OPEC Plus hinting that they still want to open the spigots even further, you can only imagine that's a sell into rallies. But that's a really difficult instrument to trade. That it's a great indicator, but things like oil is such a difficult market to trade. Again, really interested in seeing the gold price just sliding again. Similar with silver, platinum too. I mean, I guess that's just a reflection on the fact that. It's the end of the week as much as anything, but the whole, I think the difficulty that everyone's got with the market here where it is and valuations and what the outlook is, that's getting reflected in metals. If metals aren't moving and they're just in a tight range, look at the copper price, right? All the excitement initially about stimulus from China and house buildings reached a bottom and so on. If you just look at the copper price, that's telling you that stockpiles are either huge or simply because a stone has stopped bouncing on the pavement, it doesn't mean it's going to rebound. And then some of the food, I think the food input names like Chicago wheat and corn and soybean meal, that's for cattle as well. I mean, I was actually speaking to a friend the other day. He bought a steak a fortnight apart in Sainsbury's and there was a £10 difference in the price.
What?
And it wasn't
what kind of steaks is he buying?
I mean, I've no idea. I mean, he's South African, so it's huge. But
yeah.
But yeah, it's yeah. So again, those food inputs, I'll definitely keep a look at food inputs. But yeah, things like industrial metals and the things that would just say to you that the world economy is humming along are not suggesting that at the moment, which kind of fits in with what we're reading, really.
Right, so sorry, yes, Poppy has told us M&G is the asset management arm of the old Pru asset manager and put together with the UK insurance business. And the Pru bought M&G, who were a retail unit trust asset management business in the 1990s.
So that was, I remember, for my early days as a blue button at BZW. Lord Robert Marshall.
Just now, tell us why they were called blue buttons.
So on the old stock exchange floor, if you were a trainee, you would have to walk around. So you had almost like the kind of early version of the life market.
Oh yeah.
Where you would have an identifying lapel badge. It would normally have your firm and the number on.
Right.
Of your firm. But then if you were a trainee, it would have your firm and number on, but it would be blue. So it looked like a blue button on your lapel. Hence blue buttons, yeah.
Right. And you actually worked in this building at some point, didn't you?
Yeah, I used to come down for a few visits onto the life market, and that was always a pretty harrowing experience because you generally had a client in tow, and at the peak of life, kind of, I mean, especially after it moved here from the Royal Exchange, we had like 4,500 traders on one floor, split into...
In Cannon Street?
In here, yeah, literally. I think 4.5 at its peak. So you would have things like, I mean, a lot of people used to tell stories in Chicago of the S&P pit and that kind of stuff, where you could lift your feet off the floor and not move. You could get suspended. But in things like the BTP and the Bund and that kind of stuff, I mean, it wasn't that far away. You're talking about 6 or 7 rows of traders in the pits.
Right.
So yeah, it used to be a great place to come. And a lot of the time I used to have to observe the FTSE pit for expiry and for that kind of stuff, for the central risk desk, and just kind of see what was going on. But yeah, some of the pits were massive.
Yeah.
And yeah, it was always quite harrowing if you used to bring a client down, because you'd see some of your mates. So you'd say, let's go stand in the viewing gallery where it's nice and safe, there's no bad language. And you'd see a few of the guys who know, they go, come down, come down.
Right, which the client would want to, of course.
Of course the client would want to, yeah. So yeah, it used to be very interesting, interesting times.
Good stuff. Right, so yeah, Scotty, we're talking about expiries there. It's not expiry today, but it is rebalance. So a rebalance Friday, particularly interesting. After the break, we're going to talk through what is a rebalance, why does it happen, and yeah, use Scotty's expertise there. Poppy in the chat saying almost as old as me. So yeah,
as mature as you, probably.
That's right.
That's what it is.
Yeah, we've got an incredible podcast coming up with Chris and Mark, which you can see there from the knowledge that he's got on how M&G were formed.
Oh yeah, absolutely.
You know what kind of expertise this gent has, and that is very excited to bring you a podcast coming up soon in the next couple of months. So make sure you're not missing stuff like that. Do give us a subscribe, give us a like on the YouTube there, because we are struggling, people. We are really struggling. We wanted to get our subscriber number up to the same as the Rolls-Royce share price, and we're failing badly. We're only on at 817. And Rolls-Royce is 857. So we've got 40 subscribers to try and get before the end of this show. If you're sitting next to somebody, if you're in a library somewhere, if you're in an office somewhere, go on. Do it for us. Help us. Otherwise, poor producer Phil might not be here next week. We'll see you after the break. Right, producer Phil. The core PCE always comes out at 1:30 p.m. Producer Phil is now arguing that the core PCE is at 3 p.m. The core PCE has never been at 3 p.m. in its existence, producer Phil. If I promise you that the PCE inflation is at 1:30, and I will bet my life on it. No, you're not right, producer Phil. You're just right that Trading Economics calendar has it wrong. Ooh.
I'm just looking this up now, and I'm searching core PCE, and Nick Timoreas of the Wall Street Journal, who's known as the Fed Whisperer, he says the PCE price index brackets due at 10 a.m. on Wednesday. So I think they might have moved it. The plot thickens, as they say.
I'm lost for words.
.6%. You know, it's just. Let's have a look. At that, and the other. Sorry, come again.
We just had Rich there. I think you might have missed it.
Ah, was he photo
He was
bombing?
walking down some stairs that I didn't realise were behind the desk over there.
So coming up on today's show, starting in exactly 1 minute time, we've got Trump's big, beautiful bill. Is it going to pass through or not? We had Vodafone up 7% yesterday, Ronnie.
Didn't see that. I was on holiday, mate. Doesn't count.
Join us.
For those of you trading the ride-hailing space, it's all about... Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Bring me the next shiny new thing. Bring me the next shiny new thing.
That's fantastic. I did not know that was coming.
Really good.
What do you call it, producer Phil? The bloopers reel or the cherry on top, as Tasty did? Absolutely brilliant. If you missed that, we'll make sure we play it again in the next breakout as well. Oh dear, we got the stream cutting out. What a shame, as producer Phil is taking the mick out of me in that. Good stuff. Right, Scotty, it is the last day of May.
Correct.
We know that your wife also usually tells you this.
That's right.
To go away.
Absolutely.
But
She's gone away today, so I've got a week of holiday for that. So
where's Mars off to?
Turkey with some friends. So yeah.
Brilliant. Oh, fantastic. What a trip.
Absolutely.
Yeah. Okay, so take us through what happens at the end of every month.
Yes.
But this one obviously being particularly interesting.
Absolutely. I mean, look, not dissimilar to expiries. There are obviously peak flows around the quarterly events, but basically the market is a function of money flows, right? And funds are a function of money flows. So again, people would like to, I mean, I don't know if investment banks actually still forecast whether funds are going to be selling bonds and they're going to be buying equities, but some of that stuff that they used to do where you're getting longer trends now in markets. If you're a fund, why would you sell at the end of the month? Well, the only reason you're selling at the end of the month is because your clients, your end clients, want to sell. So this is just a transmission of money flows. So it can be a bit of a signal where especially where we are around relative highs in the S&Ps. I know not all-time highs, but relative. We've had 2 months in succession now of strong moves higher.
Yeah.
If we're seeing into the close, and the reason it's got to be into the close because funds are valued at the closing price every day.
And so yeah, run us through, really get that point across there.
Yeah, so funds may trade intraday or over the day, but the valuation of every fund is at the closing price on the close-to-close basis. That's a really key thing.
And what do they have to do on the closing prices at the end of the month? What does that?
It's more the case of it's a liquidity event. So for
I know, sorry, but what do they do with that number? So they say, right.
Yes, it's the
closing price.
Yes, the valuation of the fund, and not
which
just
then
that,
goes out to
which then goes out to clients, and also as well, you've got to remember if you're trading a bunch of UK stocks, but the fund is US listed in US dollars, you've got to manage your FX.
Yeah.
Which is why these things are pinned to a defined closing price every day and then every month. So then, what you can take from this is, as money flows are so key at the moment, as we've seen. So if you've had a sell-off in the S&P yesterday, it's at relative highs. Let's say if the data's are nothing done, later on in the afternoon, you'll get funds will start to skew their trading into the close, more towards the close.
Yeah.
And then if you have a continuation higher of the recent trend we've had, that tells you where money flows are. Now, generally funds won't trade every single day because you've got sells, you've got your buys, so your aggregated flows. But if you think of it at this measure, that an aggregated money flow event, if you like, happens a few times a month, so you don't overtrade, overhedge and so on, then I think it's an interesting metric when markets are at relative extremes like they are. If you watch the S&P this afternoon or tomorrow, if you're looking at your charts or whenever you do it, when you see a smooth run higher into the close or lower, that's telling you there are either net inflows or net redemptions. So it might not mean a great deal for the following week, but it just tells you where the market is at and where people want to put their money.
And of course, part of it is that if funds are, 60-40 that we talk about, then if equities go up a lot and the bonds don't move, then suddenly you're not 60-40 anymore, are you?
This is correct.
So that would cause net selling.
That's correct. But all these funds, I mean, at the big funds, all this is aggregating. So you've got funds from customers, or as you say, you've got your more traditional 60-40s, but then you've got all these arms. If you think of if you think of a large institutional asset manager globally, it has an active arm, it offers services into hedge funds, clients, retail. So all that's getting aggregated because it's quite difficult to move your portfolio around in bonds because any small movement has huge ramifications because of the size of the portfolio.
So run us through let's say I give you going back to our friend Sawyer. So Aaron Sawyer, big part of both our careers, used to sit next to us.
Legendary Aaron Sawyer,
and made it fun coming into work every day.
Yes, he did.
Sawyer has sent me, because I've asked him what's the moves into month end. He says pension funds with a rather chunky sell projection. They're modeled to sell $19 billion of US equities for month end. 19 billion to sell ranks in the 89th percentile amongst all buy and sell estimates in absolute dollar value over the past 3 years, and is in the 85th percentile going back to January 2000. So I give you a basket, right, to sell 10% of that. So you got 1.9 billion to sell. What do you do?
Well, if you're all depending on the makeup of the basket, so this is where things like liquidity analysis, skew of sectors and so on, if you're just getting a regular index, S&P 500 full replication, 1.9 billion is not going to really move the needle.
Okay.
So you would just look to put that in the closing auction because there's no point looking to take any risk around that execution.
Right.
But then all of a sudden, if that's replicated across the street, then that's when you can have a tilt into the close.
Okay.
Or actually at the close, because in the US, you have an imbalance number. So you go into auction at 350 their time.
Right.
Then at 5.2, they then look to publish an imbalance number. There's one for the open as well, but it's that much smaller.
Okay.
So this is where funds start to play almost a game of chicken about what they're trying to do. Is it a liquidity point? Other hedge funds might look to take advantage of this, or whoever it is. So you're playing a huge game of chicken run by algos, which are basically sweeping all the auctions, and then you got this imbalance number. So it can get really, really noisy. Even though a print will just look like another candle on a graph, there can be some quite intricate
And
bits
what
of game
about
playing.
what about I give you an outside? So rebalancing, of course, happens in MSCI as well, happens in indices. So let's say, you know, for example, a big trading company that has its headquarters somewhere in the middle of the city, like Cannon Street, for example. Let's say at some point in the future that goes into the FTSE 100.
Yes.
What happens with index rebalancing?
So index rebalancing, the big thing in that space and the big service that investment banks actually still provide is forecasting. So if you were a fund manager, you may be aware and you might have received reports from somebody saying, look, you know, look at this stock, you got the characteristics, etc., etc. We think it's a candidate for index entry.
And how long before would that conversation take place?
Well, you can have conversations, but it's the actual acting upon that information. So what investment banks look to do is effectively have an agreement with a customer, where some customers, I mean, even a few years ago, we had some customers where they would happily look out a month before an index rebalance and be happy to take that risk, because it's the offset of, if you only buy at the close, that's a massive signal of what you're trying to do. So you're trying to mitigate. All funds are different, but they have a mandate which only allows a small amount of the deviation. So you're trying to liaise with a customer, and they'll sometimes have an absolute number that they won't pay above. So it's not like years ago, if a stock were to go in and you see its limit up, no sellers, up 25% on the auction. I mean, obviously that has to get addressed. So yeah, it's a case of working with your customers, same as you guys do here, as we're doing, right? It's the same replication where you're just attempting to steer them in terms of...
But what about the actual process? So I give you a massive buy order for an index rebalance on a Friday before the index reweight. When do you start to stick that in?
So you generally offer your advice, because on these events, you're trying to be a consultant for execution, rather than look to take advantage of anybody, because those days, thankfully, are long gone, and the whole environment is far better. So again, you think of the process. You've got a fund manager at firm XYZ, their dealer, who you're trying to make look smart, and then you. So you're trying to feed back what are the flow you've got on the desk, obviously not explicitly, but you're attempting to look to give a picture around market conditions at the time, what might happen, sector moves and so on. So the dealer will then look to transmit that back into the fund manager, and you'll make a joint plan, because all you're looking to be is a partner on these events, because that's where you establish, if your feel for the market is good, if you've got much flow, if you're honest, if you can transmit that information well, and then you work as a team. And look, and the fund manager might just say, look, I want no risk whatsoever. I just want you to jam it in the close.
Into the closing auction.
Into the closing
auction.
So
that's one option.
Yes.
Second option?
So then you scale in. So almost like, it's almost a little like options trading. If you've got 3 levels in mind. So let's just say, for instance, you've got an order that is going to be 3 days of average volume.
Okay.
And then you calculate, okay, right, in the closing auction, average daily volume in total. So if you make the numbers nice and easy, let's say it's 1 million a day, 3 million shares order, that's basically 3 days worth of volume. Okay, then you think, well, okay, in the closing auction, if it trades 1 million shares a day, generally in the closing auction, you get about up to a quarter of the daily volume. Then that will increase because of the liquidity. So let's say 500,000 shares will go through the auction. So then obviously you're still outsized. And then what you do is, and for instance, if we were doing it today, you would maybe take a small slice of the order, and start trading it over the whole day. So you get some kind of representation of the average of the day. But then you should be flagging to your customer, look, you've got the PCE data, that could be a market mover, so on and so forth. So what you're trying to capture is a little like options trading. You're thinking about what are the risks, what am I trying to capture? And you're just trying to get a representation of the price action with a reasonable amount of risk reward skewed around a particular event.
Yeah. So and finally on this, there's a lot of people in retail land that read that so-and-so will go into an index at the closing price on the 31st of May, 30th of May. What could you say to them to just say, look, this isn't a surprise. It doesn't all happen. You don't expect up 10% in the closing auction.
That's right.
Because there's a lot of work goes into making sure that doesn't happen.
Yeah, that's correct. I mean, there is a lot of sort of overstatement of the impact of these things. But you compare it to, say, 15 years ago, a lot of funds out there actually run an index rebalance strategy. In fact, I was out with a couple of ex-colleagues of ours a couple of weeks ago, and they run an index rebalance strategy for a hedge fund. It's obviously global. So if you're hearing about a stock that's about to go into an index, that's great. But just think of it, instead of an opportunity for a quick buck, just think about it of looking at the price action, observing it. But if you're trying to participate in the auction now, it very, very much is skewed against you. Yeah. So I would just be really cautious.
Good stuff. Amazing. Thank you so much, Scotty. We'll be back for the US Open, which is in 26 minutes' time. But until then, you're going to sit here with Aaron.
Excellent.
And you guys are going to chat further about your experience in the markets.
Fantastic.
So, right, we'll see you after the break.
Thank you.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
There are certain things in our daily lives that everyone has a view on, like your favourite clothing brands, supermarkets, or even which airlines to fly with. Maybe you're loyal to EasyJet and you think British Airways seats are too expensive. Or you'll never shop at Tesco's again because Marks & Spencer's food offering has won you over. Now, what if you could use these views to try and spot opportunities in the markets? Let's talk about pair trading. It's a way to trade that focuses on the share price relationship between two similar stocks rather than taking a view on the market as a whole. Here's how it works. Take Nike and Adidas, for example. Now, some people think that Nike has gone out of fashion recently, but maybe you believe in a brand recovery over the medium term. On the other hand, Adidas Samba and Spezial shoes have been incredibly popular recently. But have sales peaked with this trend? As a trader, you could go long on Nike, expecting its share price to rebound over the coming months. Also, alongside that, you could go short on Adidas, expecting it to cool off after its big run in the last 12 months. It all depends on how you would like to express your own personal view on two companies. But keep in mind how quickly trends can shift. Remember when Under Armour rose to popularity fast, along with its share price. But then they spent most of their profits on celebrity partnerships and their share price performance flopped. Now, this doesn't just apply to clothing brands. Think of Tesco's and Sainsbury's in the supermarket space. Two companies that often move together. Now, if one outperforms the other unexpectedly, pair trading could let you capitalize on what could be a short-term difference. Because the beauty of pair trading is that it's market neutral. If the whole market drops, as long as the gap between your chosen pair narrows, you could still see an opportunity. But don't forget, always research why prices are diverging so you're not caught out by unexpected trends or their financial results. Do you want to give pair trading a try? Start simple. Test it out on a demo account first. It's a great way to learn the strategy without taking on real risk. And on IG's platform, you can explore similar trades easily with access to the tools that you need and further education on the IG Academy.
Welcome back to Trade Live with IG. I'm joined again by Scotty Byrne. How are you again?
Yeah, good. Really good, actually. Nice to be back.
Good. Well, we're now here on trading and investing experiences. So I'm really keen to hear about some of your background in the markets. I've obviously heard your ex-Credit Suisse were there quite a while. So I'm really, really interested, and I'm sure our viewers are interested on how you got into trading, investing, and some of your sort of career experiences.
Yeah, no, I'd love to. I'd love to share some of that. I mean, I actually worked for Barclays for 7 years, which actually had an investment bank then. It does now, but it had one back then. So, yeah, I worked for BZW, started there 2nd of Jan 1990. Then we got sold to Credit Suisse. And the pathway into investment banking was very different to what it is nowadays. I had a couple of friends who left school at 16.
Oh, wow.
And started as effectively what were called stockbrokers clerks.
Yeah.
And then I stayed on for A-levels, and I finished A-levels, and they were saying, no, you should work in the city, you really enjoy it, etc., etc. And so...
Post Big Bang, I'm sure this was like...
Yeah, this was just... So they would have joined as stockbrokers clerks in 1985, so they got the last 2 years of the stock exchange, and I used to meet them on a Friday night for a drink, and they'd still be in their suits with their ties down here, and had a few beers already. And I was thinking, what job pays you to go down the pub at lunchtime? Amazing. How do I get into this? So the process was then really all run through agencies. So you were vetted by effectively an employment agency, which were far bigger then. So it sort of acted like a branch of HR. Mm-hmm. So you used to get these agencies, they'd recommend you, and so on and so forth. And I went to Barclays, had an interview, kind of the fourth quarter of '89, and managed to get an offer. Back in those days, you used to have to do what was called the Blue Button program, which is, I explained to Rich what Blue Button was, a trainee. So you used to have to do about 18 months up to 2 years around all the divisions of the bank and settlements and this and that and the other. And then you could be suddenly sort of spirited away onto another area of the firm and so on and so forth. So, yeah, after my training program, I really started in earnest as a trader second half of 1991, and that was market making. And as we were talking right before we started, you're shaped by the experiences of who you learn from, and it's very key to kind of attempt to learn new things. But back then, things were very much analog.
Yeah. So
you learn on a time basis. You couldn't research things yourself.
Yeah, you had no YouTube or LinkedIn
Absolutely, nothing like that.
No ChatGPT to fire your questions.
Yeah, 100%. And a lot of the time you were the sort of lowest of the low. So even if you tried to engage a research analyst about a stock, who generally a lot of the traders were kind of less highly educated, like the salespeople and research guys, normally Oxford or Cambridge, so on and so forth, specialists in an industry. So it was really hard to get information. Thankfully, that's changed. So the playing field is a lot more level. Adding for a retail trader now, you can address those sorts of things and those questions a lot faster and a lot easier. And then I progressed at BZW from the market making into what was called the central risk desk. So that was index arbitrage, hedging. Hence the reason I used to have to go down on the live floor and see what those guys were up to, our traders and so on. Yeah. And then we basically recruited a couple of guys. In fact, one fella, Andrew Arbour, his brother Matthew, actually works here.
Oh, small world.
So I used to work with his brother, and he was basically starting the first of the computer-driven stat arbitrage strategies, which was mainly focused around mean reversion. So then we all sort of melded us all together into the program trading team once we moved to Credit Suisse, and then we all developed from there. Probably did about 12 years on the program trading desk, maybe a little longer than that, and then moved on to emerging markets with Rich, and then Rich moved on to bigger and better things. So ended up running the desk there and had some really interesting times. A lot of people ask me what's my favourite sort of recollections and memories, apart from the trading and the mechanical learning, was actually the people. Because I'm sure you find here lots of different people, lots of different opinions.
Well, yeah, I mean, as we were saying very briefly before we came on, it's always good to be around different sorts of people who've got different experiences.
Absolutely.
You never want to be in this this sort of echo chamber of your own thoughts. And I mean, in the investment world, it's very easy to sort of take this sort of dogmatic view. I think stocks are going to do X, or I think stocks are going to do Y. It's great to get that range of opinions to really, basically to reinforce your opinion, or to come up with a new idea and think, well, actually, I think they're making a really good point, and this sort of defeats some of my hypothesis.
Yeah, absolutely. And listen, it's fine to be wrong.
Of course, yeah.
If you don't accept you're wrong, that's the most dangerous thing. But it's fine to be wrong. And as in the Winston Churchill saying, if the facts change, I'll change my mind. So as you say, there is a balance though, as you say, because you don't want to spend too long looking at charts.
Sure.
And looking at some of the streams online about things are high, things are low, because that then starts to mess with your thinking, because you should be a step removed from the market. In real terms. You could be observant of it.
Yeah.
So yeah, it is the balance, and you only learn that through experience. You can make mistakes around paying attention to one source far too much, or something like that. So yeah, look, this is a learning process.
Absolutely, and I think this is why I chose to go into the industry as well, because I'm such an inquisitive person. And I think this is one of the only jobs where you have to always be learning new things.
Yes, it never gets dull. If you let it get dull, then you're not doing something right.
Exactly, and there's something new every day. It's not a boring day where you're just, you know, going through documents. There's always news coming to the markets. There's always things testing your hypothesis. There's always stuff going on. So that's why we love the markets. I'm really interested about your experience at Credit Suisse, in particular the emerging market desk. So what sort of markets were you trading there? So
this was the European emerging markets. So that would be Russia, Turkey, South Africa as the three biggest. Then Saudi obviously became a bigger slice of the pie as we went a bit further along the timeline. Central Eastern Europe, so Hungary, Czech, Poland, Israel, Greece, and then you used to do some of the Baltic states as well, but obviously they're fairly tiny markets. So yeah, you got a real sense of, it was almost like relearning how to trade again, because like we were saying about a narrative and learning from other people, when you see a headline in say on a Bloomberg or a Reuters or something like that about a Russian headline, and you go straight on the hoot, you're screaming through to your guys in Russia, they're going, no, it's nothing, that's like, it's meaningless. So it makes you get a real sense of that you need to know. If you want to find something out, speak to a subject matter expert.
Sure.
That's like anything in life, because a lot of the stuff that you read is, you know, through a particular lens. So it's fine to read that as a starter, thinking that's interesting, but you can generally find some kind of subject matter expert fairly quickly. And it always used to be a classic where every Thursday, or not every Thursday, but a lot of Thursdays, you would have a missile strike in Israel. So they'd throw a few missiles over the border into Gaza. And every time, of course, the whole trading floor is going, what's going on? So you'd speak to your Israeli broker and he'd go, yeah, it's a Thursday, it's, you know, standard really, shoot a couple of missiles over it, and they'll shoot a couple, which is almost incredible to think really that you can be so dismissive of something. But unfortunately, if you're living that every day, that's the context that you're operating.
It's actually, with that region, it's kind of the same now. We've had ballistic missile attacks from Iran. We've had stuff going on in Gaza, and the geopolitics in that region's it's still just as fiery as ever.
Yeah, completely. So then things like in South Africa, obviously things like the politics, because of how somewhere like that effectively sits, it's kind of still seen as the safe space of Africa, i.e. it still has a lot of the corporate ideals of the UK and the US, and it's a safe place for money. So that will have certain factors there influencing it, even though from the outside you think, oh, the country's in a bit of a mess. There's other outside factors which are helping it to stay underpinned.
Definitely. And I have to ask, did you do any international travel? And if so, where was the best of these emerging market nations that you went to?
Crikey. So I was lucky enough to go and work in Joburg, similar to Rich actually. It's almost like he and I almost had a carbon copy of our careers. So Rich went down to South Africa solidly for about 18 months, I think.
Oh, wow.
Worked in Joburg. I did a very similar thing, but at the time, Rich actually taught me a very valuable lesson. So if a firm sends you abroad, you want to be anchored with a contract of where you're from, not where you are.
Right,
because there's obligations. So let's say if you're working in Sydney or South Africa or Hong Kong or New York or anywhere, if you have a contract from your home office, if you like, say it's London, if, say, the world ends, you get fired, they still have to bring you home, they have to bring your belongings. If you take a local contract, you then become a local employee.
You have to go to the embassies to get you home. The company won't help.
Basically, that's effectively it. I mean, I'm sure they'd look fairly kindly on you, but you don't want to introduce that. So yeah, I think So it's very interesting in the Middle East to see. I mean, I first went to Dubai, crikey, about 18 to 20 years ago. You could see the potential there.
But now it's...
But obviously now that's been explosively realised. South Africa was very interesting because, again, what you read externally versus the people actually on the ground, they are still optimistic. But unfortunately, they've been let down by the politicians. Hungary and Poland, also interesting places. In the Czech Republic, you just learn. The best thing about it is because you're met by locals everywhere you go, you get a proper inside track on what people really believe in. And you also find as well that no one's different, right? Everyone wants to be happy. And everyone wants to look after their family and have a decent life, and that's the best thing. If you ever skew against any particular country that you don't like for some inherent reason, best thing you can do is go there.
Yeah.
But yeah, a lot of the travel was good. South Africa most probably the favourite.
Brilliant, brilliant. So I'm obviously now keen to chat a little bit about markets. I mean, we had a little chat before we came on the show here. I mean, US equities were basically at all-time highs, and we're getting this sort of mismatch from the bond market. We've got bond vigilantes who are, I'm sure many of our viewers know, but just to explain that essentially it's when yields go up because people are demanding more term premium. They're demanding more because they're concerned about the future of what's going on. I mean, we've got this mismatch where equities are going up and bond yields are going up, which means there's a sell-off in bonds. I mean, how are you digesting this data?
You have to, I think the biggest thing I would say to people, if there's experiences I could take from the last year or so, having now been trading for myself, is just firstly respect the price, but also watch your timeline. Because if you're a day trader, don't let it worry you too much because you're looking to take each day as it comes. If you have longer term investments, then you have to take more sense. For all the lessons I've ever learned, right now it makes no sense. But unfortunately, if you look at some of the best market experts and forecasters who were negative in the market through 2023, through 2024, up 25% each time, and then into this year, now all of them have now turned positive, it's incredibly difficult. I did actually find a piece from a very esteemed research company from November 2024, who basically said, we welcome the election of Trump. We're sure all the policies that, so he takes, I'm slightly paraphrasing here, won't rattle markets, etc., etc. So everyone was expecting a smooth ride from Trump, and obviously now that's been
completely derailed.
That's been completely derailed, and it's just a case of nimble thinking. If you're running a portfolio, so most institutions, as a rule of thumb, if they have a single position, will generally start really looking at it when they've lost about 30%, 30%. Now again,
and we were sort of touching 20. We didn't quite get the 20 this year, and then now we're now basically flat for the year.
Yeah. So there's certain anecdotal things, but on a single stock basis, if you put that much work into it, if you're an investing firm and you're looking at a company for 10 years, only when you get to about 30% do you start having to have a sort of meeting around
serious conversations,
what's going on and what's changing. Look, the average drawdown in the S&P in a bear market is 18 to 20%. So we've just had a standard sell-off in a bear market. And then these sell-offs of like 5 to 10% actually happen a couple of times a year. So you just need to, so sometimes it's the context whereby if you're worried about the markets, the first thing you need to get is extra data.
Sure.
So insofar as that's what we're saying now about, you can shove that into ChatGPT or research it yourself or whatever, just get some of the stats. So then you just get perspective so that you're saying, right, okay, we are in a turbulent time. And the problem is every time if you open your phone through the sell-off, every time you open your phone or look online, it's like the world's going to end. But and this is the difference where we always say to people, investing is one thing. So you can love a stock for a 5-year view, but there's no problem at all shorting it if it's on a downtrend in that particular time frame. So just having flexibility about your thinking.
And about what your sort of desired holding period is
yeah, that is so key. That is so key. And just what the parameters are of the market, and realise even though the steepness of the sell-off was obviously a sort of amplified version of August last year.
Yes.
You still have to get the context. It's like anything. If you look at a graph of the GFC 08 through 010, it looks horrendous. But then if you draw it back to a 50-year long chart on the S&P, it's a ripple. So it's just context. If you're ever feeling like you can't understand what's going on, just try to get the context around something.
I remember Terry Smith, I'm sure you know, the famous,
Terry
fund
Smith,
manager.
yeah.
He had a graph similar, did the same data, because his whole mantra is, Fund Smith, they buy quality companies. Obviously, equities are going to experience drawdowns from time to time, but he put up a chart which showed quite a steep sell-off. Then he showed the holding period of the fund, and it was just a tiny little zigzag.
No, of course. So that is interesting. I have seen actually he started returning funds, hasn't he?
Yes.
Because he can't find the kind of high quality companies anymore.
Yeah, he's got a very, very strict and limited investment universe.
Yeah.
So, I mean, he doesn't buy oil companies. He only buys really quality growth, non-cyclicals. The past couple of years, he's underperformed as we've seen sort of defense and oil do well. And I think he was underweight some of the Mag 7. So it's obviously going to be a drawdown on relative performance.
Yes, yeah, absolutely.
I mean, we're wrapping up this segment shortly. We've only got a few minutes left. I mean, what's scaring me a little bit about markets is, potentially a repeat of the carry trade unwind. Do you see any concerns over that? We've seen Japanese bond yields, 40-year bond yields at their highest ever level.
I think, unfortunately, because where central banks have got themselves, they've always got to do something.
Sure, yeah.
They can't just let the market take hold. Now, in Japan...
That's the thing with fiat currencies, right?
This is it. Yeah. That's right. And that's why you should always have space for gold. I mean, that's the only real money that exists, right?
Yeah.
I mean, except for Bitcoin, but let's not go down that rabbit hole. So at the end of the day, if you're in control of money, but you're also in control of effectively your loan market, are you going to allow the marketplace to drive your decision making? It may for a little bit, and you might have the central bank has to blink. But as you've already seen this week, what was it, on the Tuesday, you had an excerpt from the Ministry of Finance saying that they will look to lessen some of their issuance of bonds and so on and so forth. So they have to do something.
Sure.
Look, there's nothing to say that it won't still create a tremor. But again, like the rate tantrum of August last year as well, that was a fairly short-lived thing, because you realise that central banks have 150 analysts and economists and so on and so forth. So they're thinking about this stuff all the time. And there's always options. If there's fiat currency, there's always options.
For sure.
So could you see yen v the dollar at 160, 170? Yeah, absolutely. But I'm also as well reading about some of the carry trade has apparently now been moved into the Turkish lira.
Oh, interesting.
Because that's just been on a collapse. I mean, I remember I loved Turkey. I holiday there a lot. I remember I first went there. It was only 4 or 5 years ago, and I think I was getting 7 lira to the pound. Now it's some insane number like 40 or 50
and
or
60. Sort of the monetary policy in Turkey has been very strange. I mean, he was just firing people for making the right decisions, Erdogan, for a period, sort of around the COVID period.
It's a little like, in a way, it's a bit like the US, because you have your own strong internal markets. So the Turks do produce a lot of their own food, and they have their own heavy industry, and they have their own banking system, which is actually really well run. Unlike the government, it's actually a really well-run banking system, and there's a lot of strong corporates there. But because you don't drill down, you just kind of see the interest rate, and you think, oh, it must be a really badly run country. As an economy, the country's actually really well run, but as a fiscal framework, it's not well run. So that's reflected in the currency. So apparently hedge funds, again, I only read this about a week ago, have been using the lira. Again, it's a liquidity thing. So let's say if you have 100% of the carry trade in the yen, you might move a little into the lira because it's dangerous. But yeah, listen, there is nothing to say that the carry trade won't unwind again. And this is why Rich and I this morning were looking at Japan CPI and so on. It might happen.
Yeah, it's a really interesting period, and I think there's going to be a lot going on this year. So, I mean, that concludes this segment. Thank you so much for coming on, Scotty. Please like and subscribe to our new channel, and we'll see you after the break.
Thank you.
Producer Phil. The core PCE always comes out at 1:30 p.m. Producer Phil is now arguing that the core PCE is at 3 p.m. The core PC has never been at 3 p.m. in its existence, producer Phil. If I promise you that the PCE inflation is at 130, and I will bet my life on it. No, you're not right, producer Phil. You're just right that Trading Economics calendar has it wrong. Oh.
I'm just looking this up now, and I'm searching core PCE, and Nick Timiraos of the Wall Street Journal, who's known as the Fed Whisperer, he says the PCE price index bracket's due at 10 a.m. on Wednesday. So I think they might have moved it. The plot thickens, as they say.
I'm lost for words.
.6%, you know, it's just, let's have a look at that. And the other, sorry, come again?
We just had Rich there. I think you might have missed it.
Was he photobombing?
He was walking down some stairs that I didn't realise were behind the desk over there.
So coming up on today's show, starting in exactly 1 minute time, we've got Trump's big, beautiful bill. Is it going to pass through or not? We had Vodafone up 7% yesterday, Ronnie.
Didn't see that. I was on holiday, mate. Doesn't count.
Join us.
For those of you trading the ride-hailing space, it's all about...
Welcome back. So we're about to get into, in 45 seconds time, the last trading day of the year for these US stocks. We've got some big ones to watch, of course. How are we going to see Nvidia post that bit of a sell-off yesterday? Is it going to regain ground today? Now, we might also have a few people in the chat that haven't been in before. We got them in from Australia.
Wow.
My good buddies. And also, we might even have the pub quiz team in for my Sunday night pub quizzes. But
wowza.
We will say hi to you guys. Monkey Man, yes, I did just go and get Phil a coffee. Got myself one as well. So he doesn't know what I've put in it, but I did get him a coffee.
Excellent.
So, right, Scotty, get your bell up for the second time.
Goodness.
Today, we're about to open Wall Street this time. And there it is. You've never seen an opening like it on the New York Stock Exchange. Here we go. We're off and kicking, and Nvidia is actually down 1%. So 138. The stock now only trading 2.5% higher from where it was pre-numbers. Tesla down 73 basis points, 355. Scotty.
Yeah, that's been incredibly strong of late. So that's certainly having an early ease. Where's Broadcom? Yeah, that's flat Broadcom. That's had a great run, Broadcom as well. Obviously, that's an Nvidia peer, so that's been... Visa's actually been really performing well lately as well in the last few sessions, which is quite interesting. Moderna, yeah, I guess that makes sense of pharma, right? GM, Tesla. McDonald's, that had a fairly decent sell-off yesterday for McDonald's. That's been a darling for the last few weeks, really, because it's a consumer staple.
Yeah.
You know, earnings are going down.
You're long a few McDonald's in that belly, aren't you?
Mate, it's been saved away for years, that is. Deputy CEO. No, it's been an interesting one because you do get the odd occasion, the odd stories about McDonald's, because a lot of it is franchised and it's mortgaged. Yeah. So the franchises are huge and the cost of a franchise is huge. So there is sometimes, again, I've not seen a story, but there is sometimes concerns over their real estate liabilities because a lot of their franchisees are mortgaged.
Right, okay.
Because of the size of it. So they'll own the freehold, but the actual plot that it's on. So I'm not suggesting that's why they're down, but generally if the market's a bit wobbly, if you watch Coca-Cola and McDonald's, they're generally bid up as a sort of a safety play. So with that weaker consumer spending data though yesterday with that big drop, that can sometimes be. I mean, again, I don't know how you downgrade from a McDonald's. If you can go lower than that. So I'm not sure if they have rustlers in the supermarket over there, microwavable burgers, but yeah.
Right, let's see. On the upside, we've got the airlines 31 basis points higher for Delta Airlines, but be careful because that is always a wide spread this early. United, the same as well. So yeah, not really too much on the upside. Now, Wing It is saying in the comment section, last trading day of the year. Now, I'm not sure, Wing It, if you are an employee here at the company, but you are completely right. If that was a mistake or if that was a Freudian, it is the last trading of the day here at IG because the financial year is end of May. So, that's also interesting, a little added thing. I know a lot of Aussie companies actually have June year ends, don't they?
Yes, yeah.
So
absolutely,
interesting.
Yeah. Even some of the US ones have year ends in November. So a lot of the banks have year end in November. That's why you get, I think that's why if you work for Goldman and for JP, you actually get a Christmas bonus because they have a year end in November.
I wonder, I'll have to look into why we are a May year end. I guess maybe to take advantage of ISA season because that's very busy.
Well, yeah, it makes sense. Yeah, absolutely.
Right, away from the numbers, still looking at United Health. That's been an interesting one. That is consolidating around the 297 level. Let's just look at where else we're sitting. Salesforce, CRM, remember numbers were hidden away on Wednesday evening. They're down 70 basis points at 260. Actually, let's see, because last I looked, they were 280. So that must have had a bit of a weak day yesterday, actually. Yeah, there we go. They 280 post numbers as high as 290 at one stage.
Yeah.
Back down to the 265 level. So that's a little bit disappointing there. And yeah, thankfully I didn't sell any calls. I put on a few options trades in NVIDIA yesterday. Scotty, do you want to have a quick look at them?
That'd be really interesting, actually.
Oh, that's almost wasn't sarcasm.
No, almost.
Right, here, where are they? There we go.
Your S&P trades for today as well?
Not too many. I'm short.
Yesterday.
Short a bit, yeah, because it just didn't kick on, did it?
Yeah, just 1 by 2.
So
yeah,
they're
exactly right.
they're pretty worthless.
Yeah.
Right, here we go. So NVIDIA, I am short the June strangle. So I'm short the 130 puts and I'm short the 155 calls. Now that generates $450 on the puts and it generates $240 on the calls. So altogether, we're looking just shy of $700 for what as I mentioned in the show yesterday, I think it trades 130 to 155.
Yeah, makes perfect sense.
But then the additional belief is that into July, I don't think it goes below 125. So I've sold 2 of them as well, and that takes in another $500.
Yeah, that makes sense.
Yeah, so that's the kind of update. I'm still short Adidas. They fell to earth yesterday after trading 224. I am a little bit worried about my GBP position. So I've got 2. I'm short the euros and short GBP, but yeah, I'm not sure about that. After reading what Trump has tried to sneak through in his tax bill, clause 899, does make me think, are we going to see the anti-US exceptionalism money flow out yet again?
Yeah, I mean, I did see actually in the Times this morning, kind of summarising this week, where you've had just a little bit of an uptick from some of the UK data. Again, it's not great, and then you got a little kind of a green shoot, and then it's stamped on with the thoughts of Reeves forcing through rules to make you invest in the UK. I mean, surely it should be done the other way around, make the UK attractive. But again, yeah, I think FX at the moment, for like a long time view, you've had a reset in the sterling and euro, right?
Yeah.
And the dollar is where it is. Then I don't really see in the short term what's the catalyst for another further reset in either direction. It seems like we're circling around the airport in those 3, as it were.
Well, talking about circling around the airport, we've got Nick Lemon in the chat there. This man went missing for 48 hours in Las Vegas.
Goodness me.
We were on a stag do. Literally, it was like the movie The Hangover, and Lemon went missing. which was we weren't really concerned, to be honest.
No, I mean, has he ever hinted at what happened in the 48 hours, or is that for his book?
Yeah, let's see Lemon come out with a book. I'm not sure what he would call that. Maybe the Rouge reports might be it, as he's told himself there in the chat.
Absolutely.
Right, Kirky, is there an IG email address for the team that you can use to send the question? Yes, there absolutely is. It is ask@ig.com. So ASK, ask the question, in case my Scottish accent is butchering that there. So just ask@ig.com. Not to be mixed up with askhr@ig.com.
Yes, that's right.
Because some people do get mixed up and send their HR emails to ask@ig.com.
Wow. Okay.
So yeah, if I was to
filtered,
be reporting Scotty.
Yes, that's right.
For
misdemeanors.
Misdemeanors.
That's what you would. That's
who's Mr. Demeanors?
Oh well, I think we all know.
Right, away from the numbers, saying Nvidia vol has collapsed. That's right, only 11.5 on the IVR on the Tasty
really
platform.
Low, isn't it? It's really low.
Yeah, it's it definitely got hit there. So good stuff. And Cal, big Cal on the chat as well, or another. This is Cal went searching for lemon in Vegas.
Oh wow!
So yeah, big Cal. Big shout out to you guys. Of course, you are going to subscribe to the channel, aren't you? Because we are currently approaching 820. If Rolls-Royce profit warns this afternoon, we might have a chance.
You could cross the line. I suppose not forget it's month end. Who knows?
It is month end. Anything can happen, Scotty.
Anything can happen, that's right.
What is your... because, of course, Scotty used to actually work with Matt Arbor's brother. So you see Matt Arbor sometimes on the channel here yesterday. Yeah, you worked with Matt.
Yeah, incredible. Same hair, the pair of them. Honestly, unbelievable.
Right.
Yeah, unbelievable. Yeah, he's a very good guy. A very good guy, Andrew. Yeah, he's very good.
Speaking of hair, have you been to Turkey recently?
No, I'm actually letting it grow out. I was thinking to myself, after now I'm a TV star, as I like to tell people. So I now like to refer people onto my agent now if they've got a question for me. But yeah, I thought to myself, it was a cross between should I shave it and make my head look even shinier under the lights here, or just kind of leave a bit of fluff on top and strip some of the glare away for the viewers. I don't want to hurt people's eyes on a Friday.
That is without any trips to Harley Street.
Absolutely,
or,
yeah.
On British Airways, as they like to call it.
Yes, that's right, British Airways indeed.
Good stuff. Right, Scotty, this has been extremely enjoyable going back over down memory lane. We've got, it is now 9:10. Dr. Jim Schultz coming up for you next. I interviewed him only yesterday afternoon. We've managed to chop it up and get it out to you. And after that, stick around because we've got the week ahead coming with ESAR. ESAR is going to look at all the big info coming up next week. Keep an eye on our shorts, as in not because it's summary tomorrow, but keep an eye on our YouTube shorts. We're going to have pump a few more out there today. And then we'll see where the month ends. Maybe that's the last poll of the day. What is the S&P 500 going to be at the close tonight? Scotty, give the team there 3 options to put down in the poll.
Oh, crikey. Let's have a little think. I guess...
As you think, just for context, the S&P 500 month to date is up 6%. The FTSE is up 3.6%. The Nikkei is up 5.4%. German DAX up 3%. And the CAC 40 up 6%. China only up 0.2% on the domestic market. Hang Seng up 3.5%. So it's been a generally positive month. And for you Aussies in the chat viewing for the first time, the Australian index up 3.8%.
Wow. So I guess in percentage terms from last night's close, I'd say the options would be up 50 bips, down 50 bips, or down 1%. I'm just a bit tilted to the downside. Just
tilted. Right. So we're talking 58.50, 58.75, 59, or higher.
Yeah, or higher. Yeah.
Yeah, 58.50, 58.75, 5,900 or higher than where we currently are. Good stuff. Enjoy the Jim Schultz interview. I will see you on Monday, but stick around for Jim Schultz and then Isar after to take us home. There might even be a little bit of a 5-minute quick interview with Angeline there to tell us what she's been up to in Milan. Has Angeline gone missing in Milan as Dylan did yesterday? Join us after the break.
So my guest today is one of the most recognizable educators in retail trading. He's known for simplifying complex options strategies and doing it with unmatched energy and heart. Known as the Doctor from his PhD, a longtime face of Tasty Live, and someone who blends discipline, data, and a deeply personal approach to finance. Please welcome the one and only Dr. Jim Schultz.
Man, what's going on, man? It's really exciting to be here with you today, Rich. And you know, it's a long time coming, our being able to connect here. And I'm excited, man. I'm excited to see where we go today. And it's been quite a ride with Tasty for the last 10 years.
So yeah, I want to dive straight into that really, because across in London, our viewers are only just getting to know you guys. You know, you're celebrities in Chicago, you're celebrities around America. But for those over in London, in the UK, please introduce yourself.
Yeah, so, you know, Jim Schultz, I've been studying finance for, 25 years now. And so I grew up in the eastern suburbs of Detroit, Michigan. And, just a middle-class family, lived in a very normal neighborhood. My dad worked all the time. My mom stayed home with me and my 3 sisters. And so I was actually the first one to go to college in my family. And so I went to undergrad, MBA, and PhD all the way through finance all the way. And then I graduated in 2009, and I graduated from the University of Memphis, and I finished my doctoral work, and I left Memphis with 2 things, with a PhD in finance and the most wonderful woman in the world as my wife, Autumn. And so I took my first job as a professor in a small university in South Carolina, and I taught there for about 6 to 6.5 years, I want to say. I taught undergraduate classes, I taught MBA classes, and it was amazing. Like, I thought that was what I was going to do for the rest of my career. Yeah. And then in 2015, I met Tom. Like, in 2015, I started kind of getting to know Tom, and, one thing led to another, and I was like, hey, maybe I could join the team there and be a part of what you guys are doing, because I was like, man, I can always teach. I can always go back and teach, at the university level, whatever. But this looks like a once-in-a-lifetime opportunity. And so I got to know Tom. He gave me a shot. The rest is history here 10 years later. So that's, absolutely. I mean, that is like the Cliff Notes version of kind of my story.
And where was that first meeting with Sosnoff then?
Yeah, so I mean, I met Tom in Chicago first. So I was in Charlotte, North Carolina, and I was still teaching. And I got to know Tom via email, which is how most people get to know Tom. And then eventually I was like, hey, I think I can help you guys out. Let me come to Chicago. Let's sit down. Let's talk it out. And let's just see where it goes from there. And so I flew to Chicago, sat down with Tom, and that's how our courtship began back in 2015.
Oh, fantastic. Now, I have noticed you've got a certain energy on air that is just, completely your own. And you managed to do those, is it 1-hour shows all by yourself?
It's 45 minutes. It's 45 minutes. Yeah.
And so, has that always been there from teaching, or is that something that you've managed to build up over time on air?
Yeah, that's a great question. And I'll tell you, so if we go all the way back, oh, Rich, you're taking me back this morning, man. I wasn't ready for this. If we go all the way back to like 2006, so that would be, for people out there that have been in a doctoral program, like, you'll recognize what I'm going to say here in terms of like what you do with your workflow. But most people are not familiar with kind of what you do in a doctoral program. So typically you do 1 to 2 years of coursework. At about the 2-year mark, you take your exams. You take an oral exam and a written exam. The oral exam is basically like, the study guide is finance. Like, that's it. Like, you have to be able to address basically anything in the field of finance coming from your professors and your dissertation committee and all those things. Then the second 2 years, or the last 2 years, I should say, is when you work on your dissertation. And that's when hopefully, you put together something that's reasonably worthwhile and they let you out. And then you get to, go off into the forest on your own. Well, right around the second year mark, that's when you typically start teaching classes. You're doing research, you're teaching classes. So I started teaching classes in 2006. And Rich, let me tell you something. It was a train wreck. Oh my gosh, it was a train wreck. Oh my gosh. I got up there, lecture halls, 80, 100 students, whatever, and they just torched me. Man, they just blew me to smithereens. And so I realized, I was like, man, I'm either going to sink or I'm going to swim. Like, I'm either going to sink to the bottom or I've got to rise to the occasion and become way better than I currently am. And so what started to happen was I started to really arm myself and equip myself with what I thought I needed to, have the answers to my students' questions and just have a really firm grasp on the material. And because of that, I think it gave me a lot of confidence. And from the confidence, that's kind of where I think the energy and the enthusiasm was born.
Right. So it was in the face of potential failure that you kind of reached deep and realized that you had to be engaging, that you had to really draw the students in.
That's right. That's exactly right. Because, it's like, I'm the only one up there. It's like, I remember I used to walk into class. I was 20, let me think. I was 25, I guess, 24, 25. And I would walk into class and my students would look at me and they'd be like, he's the guy that's going to teach us? He should be sitting next to me. Like, why is he up there? And so I realized, I'm like, man, no one's coming to save me in here. It's just me. I've got to manage all this myself. And so it really, really forced me to kind of up my game. And so, man, I give so much credit to my students. Oh my gosh. Especially those early years, they really, really forced me to be the best version I could be in the field of finance. And so having to face that adversity pretty much every single day was quite an opportunity for growth for me.
And so did you teach options, or is that something that has progressed, since?
Yeah, it wasn't option specific. In fact, I taught very little option specific material pretty much my whole time as a grad student, doctoral student, and then even as a professor. We taught some options. They would show up in like in investments class. I think there was maybe one semester I did a derivatives elective. I can't remember exactly. I think maybe I did it one time. But most of the time it was very corporate finance based. It was very principles of finance, net present value, some investment stuff. But in the field of investments, you're doing modern portfolio theory, which is a misnomer, by the way, because it was written in 1962 and it hasn't been updated since. And so you've got that, you've got the Sharpe ratio. You're doing like those kinds of things. You're not really doing anything from an active trading standpoint, whether it be derivatives or anything else really. And so that honestly is what drew me to Tasty. And I was like, man, what they're doing is changing. This is going to completely, revolutionize finance for the retail trader. And so that's why I wanted to be a part of it.
And, since then, that's exactly what you've done. So take us through the sort of the events that you host, specifically the one earlier this year, which was fantastic.
Yeah, so I've done some live bashes. Yeah, we did the live bash earlier this year, the beginner trader. And that was amazing because we got to do it to a live audience, which was super fun the night before. And then I did the recording the next day, which was really, really great. And then later this year, I'm doing an options crash course live. We're going to 3 cities. We're going to Boston in July, which is just coming up in about 6 weeks. Then we're going to Detroit in October, and we're going to Tampa Bay in December. And so I'm really excited about it because there's just nothing like being in front of a live audience, which I know that you know very well yourself. And so the energy is amazing. The rapport is amazing. You're kind of able to see, like, all right, is what I'm saying, is it making sense? Is it not making sense? And again, I like that for me personally because it takes me back to the classroom. It takes me back to the classroom. I love what I do every single day, from theory to practice, being on camera, being on air, whatever. But nothing can replace the face-to-face interaction in a learning environment. Because it was always a very special thing for me as an educator to actually see the light bulbs go off.
That's it.
Like, you just see a little flicker, you're not getting there, then all of a sudden, the light bulb just goes off, and it starts to make sense. And to see that live, there's just nothing comes close to that, in my opinion, as an educator. So that's why I'm so excited for Boston, Detroit, and Tampa Bay coming up this year.
And often when you're on with Sosnoff, he'll bring up a point or an argument, and you remind him, if only there was a show that took you from theory to practice. Just walk us through exactly what you try and do in that show.
Yeah, so I have to give a quick shout out to my father-in-law because he's the one who named the show. So this is a really funny story. So in 2015, right, I meet Tom, we're exchanging emails, I fly to Chicago a couple of times. It's like the fall of 2015. It looks like, all right, this is really going to happen. I'm going to join the team. We're going to move to Chicago. Like, this is going to be so exciting, whatever. And Tom said, he's like, all right. He's like, you're going to have your own show. It can be whatever you want it to be. He's like, you just got to let me know what you're going to call it. Yeah. And I had no idea. I came up with all these crazy names. I can't even remember them anymore. But then we were sitting at our kitchen table in Charlotte, North Carolina. It was maybe 2 weeks before we were set to move to Chicago. Wow. I'm sitting there with my wife and her dad, so my father-in-law. We're talking about it, how excited I am. But I told him, I said, Steve, I'm just I'm so concerned because I don't have a good name for the show. And we need something that's catchy. I need something that people are going to remember. He didn't even hesitate. He goes, from theory to practice. And I was like, man, I like that. He's like, hey, you're an academic. You're leaving academia to kind of show people how it really works. You're going to kind of blend the two things together. I was like, Steve, this is great. So I sent it to Tom later that night. He's like, I love it. That's it. And so it's been from theory to practice for 10 years now. So I had to give a quick shout out to my father-in-law because he named the show. But that's basically what it is, right? Like, the thing that's been so fun and exciting for me being with Tasty is I love the classroom and will always have a special place in my heart. But the thing about it was, Rich, is, I'm in class and the students are learning and they're excited to learn, and I tried to make it engaging and fun, but still, they're just learning to pass the class. They're just learning, to move forward in their academic career. Most of them are not even going to major in finance. Most of them are not even going to do anything in the investments world. Well, I joined Tasty, and all of a sudden, you want to talk about having to bring your A game. You want to talk about having to rise to the challenge. All of a sudden now I'm like, man, there are people on the other side of that camera lens. There are people in the audience at the live shows. Like, they're basing dollar amounts behind what I say. Sometimes 6 figures, sometimes 7 figures, sometimes 8 figures, 5 figures, whatever it is. It's a significant amount of money. Yeah. So all of a sudden I realized, man, we're not talking about A's and B's anymore. Like, we're talking about some really, really serious stuff. And so when I thought about the show, I was like, man, there's just so many things in academia with all the models and the theories and whatever that actually matter to us as retail traders. Some of it matters on the front lines, like the decisions that you're going to make, on a given day. Some of it matters more as kind of background information, but a lot of it really, really matters. And so on the show, that's what I try to do, is blend those two worlds together and show the people that are watching that this isn't just about some textbook. This isn't just about some, archaic theory that nobody has thought about for 60 years. This actually matters to you, and here's the reasons why.
Great. Now, for our viewers, mostly going to be across here in either UK or Europe, we haven't grown up with that availability to the options market. And it's just not as liquid across here. There's not the same kind of knowledge or availability. What do you think is the best starting point to bridge that gap and to get the UK more interested in trading options?
So you mean, what is the best starting point in terms of like strategically, or what is the best starting point in terms of like access?
I guess to the people watching, that it all seems a little bit too much for them, too advanced. Sell it to them, Jim.
Yeah. Okay. Well. Okay. Got it. So it's strategically. Got it. Here it is, Rich. This is exactly where every single one of your viewers, of our UK audience, of the people that are across the pond, this is where they should all begin. 100%, 10 out of 10. Here you go. The covered call strategy. This is it. So you can write that down. You can make a note. You can hop into the Tasty Live archives later on today or this weekend or whatever, and you can learn more about the covered call strategy. Here's the reason why. A lot of investors across the world, whether it be US, UK, Australia, whatever, you're familiar with owning stock. You're familiar with owning some type of mutual fund, index fund, individual stock, whatever. That is comfortable for you. You understand that landscape. I buy it, the stock price goes up. I buy it, the stock price goes down. I make money, I lose money, etc. The covered call is great because, yes, you are correct. The world of derivatives and the world of options and futures, it's very complex. It's very overwhelming. There's so many different things that are happening. With a covered call strategy, the strategy actually begins with long stock. It actually begins with something that you're probably already familiar with. So you're going to have that comfort. You're going to have that familiarity that you wouldn't have with other strategies that don't involve long stock. Now, on top of that, you're going to add what's called a short call. Now, that changes the dynamic in some significant ways. And I'm not going to get into that now because that's not really the purpose of what we're doing here. But it's going to give you that comfort that you wouldn't have in other strategies. And then you can start to learn the subtleties and the nuances. And the profit loss diagram is not that dissimilar from just holding long stock. It's a better play strategically. It's a higher probability play, but you still have that familiarity of long stock. So that's 100% where I would start. And then from there, you can do all the crazy stuff, Rich. Like you can do the Rich McDonald strategies where you're selling straddles in gold, right? You're doing strangles in Bitcoin. You can do all that stuff later, right? It's not a race. It's not a competition. Right now, start with the covered call. I think it's a great start.
And then what are your learnings from both, back in the days teaching finance and then adding the options expertise on top? What do you think is the one single message you would like beginners, both to investing and trading? What would you like to get across to them?
Yeah. So, and you kind of alluded to this a couple seconds ago. So I think that the number one best thing that I can suggest to people that are just starting out is you have to know what you are signing up for. You have to know what you are signing up for. You have to understand what you're getting yourself into. Now, right now, there's no way that you could possibly know that because you don't know what you don't know, right? So there's no way you could possibly know that. But later on down the road, you want to be very clear on what you're signing up for. Like, what are the risks? What are the benefits? Right? What are the gimmies and the gotchas? That's one of the things I love to say on my show all the time. For every gimme, there's a gotcha. Like if you're going after a gimme of a high probability, there's a gotcha there. You have to understand that gotcha.
Nice.
And
I
so
haven't heard that before. I like that.
Yeah. The reason why I bring that up now is because any time that you spend as a beginner trying to better understand the ins and the outs, the gimmies and the gotchas, what have I signed up for, that is going to be very, very fruitful investment on your behalf. I've just learned that there are many, many, many traders, even still today, that don't quite know what they've signed up for. They don't quite know, what have I signed up for? What are the gimmies and the gotchas? What are the risks and the benefits? And so I think that would be the best possible way to start as a beginner. Just keep a little file in the back of your mind. What have I signed up for? And keep trying to work to that end to really understand what it is that you have signed up for. And I think that that's going to make things less overwhelming. I think it's going to lead to faster, mastery of the material, which is kind of that's what we're all trying to get to.
Amazing. Inevitably there's drawdowns along the way, isn't there? How have you, as you're, in your own trading journey, how do you learn to cope with those drawdowns that a lot of people might have seen in the past 6 weeks, for example, or it could have been COVID? There's been many situations that are, they've been really tough to avoid. So how do you manage that personally to deal with those?
Yeah, so it's so interesting that the timing of this interview is you asked me this question right after the previous question, because the answer to this question actually highlights the importance of what I just said. You have to know what you've signed up for, right? This will help you immensely when it comes to drawdowns. For instance, like one of the strategies that we love to use, at Tasty and as premium sellers, option traders, whatever, is a short strangle, right? Now, again, this is way down the road. Don't worry about this yet if you're just starting out. Start with the covered call and then go from there. But the short strangle is an unlimited risk strategy on both sides of the market. You have undefined risk on both sides of the market. So what that means is if there's a big move in either direction, whether it be up, because of, like when Trump, tweeted out, hey, you should buy stocks, and then there was the 90-day pause and the market ripped up 10%. Or even prior to that, you had a couple of days of like 2, 3, 4% down each day. You're exposed to that risk, like completely. There's no safety net. Like there's no inherent stop loss that's built in. You need to understand that that is what you're signing up for. And so if you don't know that, it can make the drawdowns incredibly difficult to handle because you get surprised and you find yourself kind of searching for what you do next. But again, if you understand what you're signing up for, it actually helps the drawdowns immensely because you're like, all right, this is part of the game. This is part of the game. Like, this is what I've signed up for. So what am I going to do next? Like, what's my next move? But this should not come as a surprise to you. And then what happens is when you have big moves like that, the term I like to use a lot, or the thing I like to say a lot, is it exposes you. It exposes you. So it's not too different from when I was in the classroom. When I was in the classroom teaching the first couple times, I was exposed. The spotlight was on me and all of my flaws and all of my mistakes and all of my lack of understanding. It all came out and there was nowhere to hide. It's the same thing with a short strangle, a futures contract, whatever you're engaging in that's fairly high risk. When there's a big move, it exposes you. Okay, now all of a sudden, how small were you really with your position size? How small were you really with your overall capital allocation? You're going to know very, very quickly. And so it can be an incredible learning opportunity for next time. But again, it all traces back to knowing what you've signed up for. So when it comes to drawdowns specifically, that's incredibly valuable to help to handle the drawdowns and stay poised. Stay poised, stay calm, and be able to execute on your strategy.
And this is why part of the Tasty mantra is begin small and take lots of small positions, because then it's a little bit harder for you to trip yourself up, isn't it, if you're not in anything specifically too big.
That's right. That's exactly right. I mean, trade small, trade often. That's exactly right. I mean, we want to feed a lot of small trades into the data set to allow the probabilities to work over time, right? I mean, if you start trading too big and you're trading more infrequent, yeah, it might work, it might not work, but you're not really leaning into the probabilistic, outcomes that we're really trying to tap into. And so that is exactly right. Trade small, trade often. But again, still, you don't really a lot of people don't even know. This is something Tony Batista says all the time, and it's great. You don't really understand how small is really small. A lot of people don't really know what is small until they get exposed, until they get caught with their hand in the cookie jar. Yeah. And then all of a sudden it's like, okay, now I know what I thought was small was probably still a little bit too big. And so again, it's a very interesting dynamic when the spotlight gets shown on everybody, and then you get to see, all right, does the emperor have clothes on or not? Like, you're going to find out real quick.
Yeah, Buffett's when the tide goes out, then you find out who's got their trunks on.
That's correct. That's 100% right.
Now, I think a trading psychologist that we had back in the Credit Suisse days, he said it best. He says you know a size of a position and you know if you're too big, because if you start to pray, then it's probably already too late. It's time to get the stop losses in. And that takes me perfectly into my next question. You mention your faith sometimes live on TV, and it's something that I picked up on. How does that faith help you navigate your trading?
Yeah, that's a great question. So that's a really good question. So as a Christian, I am 100% all in on Jesus as my Lord and Savior. And for me, what that does is it allows me to go forward boldly into the world and do what I think is right and do what I think I can do to the best of my ability, because I know that my hope is ultimately secured in the cross. And I know that my future is ultimately secured in what he's already done for me. And so that, honestly, the number one word that comes to my mind whenever I think about, my faith, whenever I think about what Christ has done for me, it's freedom. It gives me unbelievable freedom to go forward into the world and just try to do the best I can for God's kingdom. And so to me, that is way more important than a strangle. It's way more important than a drawdown, to be perfectly honest with you. But it helps me so much with those things. And I mean, I mess up and I make mistakes and I do too much here and I do too little there. I do the same things that we all do. But at the end of the day, to be able to think back, like, all right, everything is going to be okay because of what he's done for me 2,000 years ago, that's the one thing that I keep coming back to almost on a daily basis. And the beautiful thing is, Rich, the days that I do forget, which is often, my wife is right there to remind me, which is very, very, very helpful.
Excellent. But there are quite a few of those values that overlap, aren't they? Like patience and discipline, very much part of his teachings, but also, what can stand you in good stead in trading?
Yes, I would say self-control, 100% self-control. So when you think about, the fruits of the Spirit, which I think Paul writes about in Galatians, it's either Galatians or maybe Corinthians, but the fruits of the Spirit, right? You've got self-control. I think for a trader, that might be the one that would stand above the rest. Because at the end of the day, I mean, the math is the math. At the end of the day, the probabilities are the probabilities. And I feel very good about what I'm engaging with mathematically. But the question becomes, all right, what about what's happening inside of me emotionally? What about what's happening inside of me in terms of my, my behaviors? Am I going to be able to actually execute the plan? Am I going to be able to actually do the things that I know that I should do? I really think it all comes down to self-control. And I mean, it's one thing to have self-control when everything is working and you've just got winter after winter after winter and everybody's strawberries and sunshine. But what happens when, you're short on that 10%, Trump tweet, rip higher? That's not so fun anymore. So now the self-control gets exposed. Or when you're long and, the liberation day happens and the market just falls through the floor, right? Once again, do you have the self-control necessary? And it's an ongoing thing. Like I certainly I'm not batting 1,000. Nobody's batting 1,000. But I think as we try to grow and as, we are, as Christians, as we're sanctified, these things should become better and stronger and more powerful over time. And so as a trader that is overlapping with those Christian values, I would have to say the self-control would be the number one.
Taking that in, which option strategies would you say best captures your personality?
Yeah, that's a great question. I would have to say, that's such a good question. I would have to say probably the undefined risk ones, which are going to be the short strangle and probably the put ratio spread. Those would be my number two. I'll throw the short put in there too. It's really hard for me to pick which one is best because I rotate. It's going to be one of those three: short strangle, short put, or a put ratio spread. And so for me personally, I've usually been more risk averse in my life. Generally speaking, I'm more of a risk averse person just by nature. But when it comes to certain things, I'm not. And it's kind of a weird dichotomy. It's a weird blend. Yeah, I can't really explain it. I don't know. Like when I drive, like I'm a very, very risk averse driver. In fact, I'm so risk averse, I'm actually a bad driver, Rich. I'm terrible. Like I'm just letting you know right now, if it's ever you and me on the streets of Milan, man, you should find another driver, 100%. But when it comes to investments, maybe it's understanding the risk return profile. Maybe it's understanding betas and understanding alphas and understanding what we're trying to go after. I just naturally start to head towards the end of the curve where the returns are greater, but the risks are greater. And I just think that the payoff can be so much more substantial, for us as traders, that I tend to gravitate to those.
Great. I do a lot. I love a put ratio spread. Just gives you that, I'm bullish down here, but I want to participate in the way down. So yeah, gives me I'd say that's probably one of the most common ones I've used throughout my career, as well as now trading with my own funds as well.
It's a great strategy because, again, like you just said, you kind of have opportunity on both sides of the market. And so that's what makes it so fascinating. It gives it so much flexibility that is really hard to find in a lot of other strategies, even the strangle. The strangle is amazing, but man, the put ratio just unlocks a whole new world of management and opportunity, and it's second to none in my opinion.
Now, for those people at home that want to learn more about what a strangle is, what a put ratio is, how do they find your wonderful live show on the old internet out there?
Yeah. So I'm live every day at 2 o'clock Eastern from theory to practice. And so you can watch the live show. If you missed it on the live show, it's 45 minutes or 2 to 2:45. If you missed it on the live show, you can always watch it in the archives. I mean, I've got archives going back again 10 years now. So if you want to see some really, really, really bad stuff, go back to the first couple shows. Man, they're really, really bad. And then hopefully we've grown a little bit over the years. But yeah, I mean, from theory to practice is every day at 2. Monday mornings at 9:40 Eastern, I do a show with Tom and Tony called The Skinny on Options Abstract Applications. And this is where we really try to push the envelope on some of the like higher level theoretical things and tie them into trading and tie them into derivatives. And sometimes we do a better job than others, but we're trying to reach to better understand some of like the crazy theories that are out there and how they might apply to us. I've been doing that now with Tom and Tony for about 6 years, I guess. And so that's every morning at 9:40. And then those are my two. What's that?
I'm surprised that that one's not, that part of the show isn't called Teaching Old Dogs New Tricks.
You know, it should be. It should be. But Rich, I've tried, and you know this because you've been out with Tom a number of times. You can't do it, man. You can't do it. Like, you're giving me an impossible task, right? Like, give me
anything, Dr. Jim.
No, nothing. Nothing at all. And so, oh, that's so funny. And so those are my two live shows. But honestly, Rich, you know, for people that are out there that are just checking us out for the first time, go into the Tasty Live archives, and there's so much material, right? I would test out a few different shows. I'm obviously biased towards mine. But hey, check out Liz and Jenny. Check out Mike, Nick, and Katie, right? Check out Jamal. Check out Chris and Ilya. Like, check out a few different personalities, and then you're probably naturally going to gravitate towards one or two of them. I would sink into their content in the archives because you've already kind of latched on and synced up with the way that they explain things. I think that will make your learning a lot more effective because one of the things that I think is a huge benefit to what we do at Tasty, but a lot of people might view this as a drawback, is we all don't say the same thing. We're all not just rotely copying each other one for one, so it's just the same PowerPoint presentation over and over and over again. We don't do that at all. We all agree on the same 5 or 6 core principles, right? High volatility, high probability, selling options rather than buying options, etc. But the way that we actually explain that and the way that we implement that is different for everybody. And so as someone on the other side of that, someone in your audience, that can be very frustrating. But if you can get over the initial hump of the overwhelm, what that's going to do is it's going to give you different perspectives on the same thing, like, you know, short delta or a put ratio spread or whatever. And then little by little, you'll start putting in more puzzle pieces into the puzzle. And then that will help you kind of reach that level of mastery that you're after. But I would start with 1 or 2 of the hosts on the network and just really sink into their content.
And that's interesting. You know, seeing similar things from a different point of view, you could call it the New Testament.
Yes, you could. That's pretty good. I would copyright that. Yeah. Oh man, that's pretty good. I may use that again.
Good stuff. Right, Dr. Jim, it's been an absolute pleasure. Thank you so much for joining us. And I know the people out there watching from London, from the UK, from Europe, there's going to be an invitation to you, sir, to come across and do one of your magnificent teaching sessions in London at some point. Would be wonderful to have you.
I can't wait. That would be so much fun. Thanks for having me on, Rich. It's been really great.
Good stuff. Peace.
Hello, welcome to Trade Live with IG. I'm Martin Harris. I am cosplaying as Angeline Ong for today. I'm basically doing my interview to take over the role. Angeline, we've obviously sent you to Italy to get some news on the ground for what's happening in Europe. How is the holiday going so far? What can you tell us?
Buongiorno, greetings, come stai from Milan, where it's beautiful. It's 29 Celsius, if not hotter, blue skies, and it's been amazing this week. Obviously, you know, missing you guys. Hope you've all been looking up to my friends. Producer Phil and all those in the gallery, Dom and James as well, and Rich, of course. You've been looking after everyone, right?
I'm looking after everybody at this point. Supervising things here. So, Angeline, in terms of what you're seeing on the ground there, we've got European inflation coming out next week. What are your expectations there? I see market is expecting 2%.
Well, the market may be expecting 2%, but I can tell you right here on the ground, it is feeling hotter than normal. So, for example, my favorite thing of all time is, of course, coffee. And, we're seeing coffee being sold at a price that's more expensive than in London itself. Your gelato, I've been eating my body weight in gelato. Outskirts, you might see it like €3.50, but it's all creeping towards that €4 mark. Every shop is selling stuff.
Okay, so the gelato index is on the up, coffee is on the up, all leading to higher inflation expectations.
Exactly.
What about limoncello?
Limoncello. Well, I haven't had limoncello yet, but an Aperol spritz is €5.
Right. Okay. So we'll leave it at that. Angeline, thank you very much. Thanks for the reporting on the ground, coming to us live from Milan.
A pleasure. We'll see you guys back, Trader Friends, on Monday. Looking forward to it, and I'll be catching my flight this weekend.
See you then. Thank you, Angeline.
Oh, I've been trying not to laugh on the side, but good to hear from our Italy correspondent.
Yeah, it's great to see just how far we've come with the trade line with IG.
Yeah, it's real presence on the ground.
Exactly. Presence on the ground, global journalism at its finest.
Well, Martin, we're here to chat about the week ahead. But...
We are. Thank you for joining us, Isa. So I've got the earpiece. Yeah. Fortunately, we've got you as the week ahead expert. This last week, we've seen a few things. Yesterday, I think we had some revisions to consumers, consumer expectations. We also had initial jobless claims. What we're seeing, a little bit coming out of the United States, is that Doge looks like it's actually starting to take a bite out of the employment figures, and we're starting to see initial jobless claims creeping up, particularly in the Washington D.C. area. Just before we joined, before we came on into the studio, you were talking about what housing was looking like. Tell us a bit more about that.
Yeah, sure. So there's some interesting data that's suggesting that the housing inventory in Washington D.C. is really rocketed up, basically in the kind of couple of months that Trump has been in power. I think an indication of a couple of things. Number one, obviously, the fact that people in government roles are feeling less secure about their jobs and maybe looking to move. I think the second thing is just more generally about the uncertainty in that kind of area, not just for government workers, but also contractors who work in DC alongside the government. So I know, for example, as we're seeing a lot of the defense work shift away from the US and towards the EU, that might lead to some jobs changing as well. So either way, interestingly enough, we're seeing a huge flood of houses onto the market, and that's then leading to quite big changes in the house prices, which is kind of a weird, fascinating byproduct of some of the Doge stuff that you were talking about.
Yeah, absolutely. I think we'll touch on what's going on next week.
Yeah.
We'll take a look at the calendar, and then if there's anything else, we can also revert to some questions from the chat.
Yeah.
Take us through the calendar for next week.
Sure.
We can start with the economics and then look at a few of the stocks.
Yeah, so I think one thing worth saying is we are about to enter June, and this is always a very quiet period of the year. There's kind of the running joke, which is sell in May and go away. Yeah, and you see lower liquidity, and so then often some of the moves, it's a bit of silly season sometimes in the stock market at this time of year. So I think if we're looking ahead to next week, there are a couple of data points that we should be keeping an eye on. There's the US jobs data. That's going to be the biggest thing that I'm looking for next week. In particular, you've got ADP doing their jobs reports, but you've also got the kind of Friday classic big jobs report and the JOLTS data from the US Bureau for Labor Statistics. So it'll be good to get kind of a clearer view on, we've heard some rumblings about maybe the consumer is slightly weaker, maybe the economy is starting to look a bit shaky, we've had some tariff effects. Is any of that really feeding through to jobs data? And I suspect the answer is no, because while we've seen a lot of uncertainty, I don't think we've seen a huge amount of people making like negative investment decisions yet. But we'll actually see, and I think the proof is a bit in the pudding. So let's wait and see what that data looks like. So I think that's big data point number one. The other macro data point, which is actually the third one on this list, is that we have EU inflation next week. That's kind of what we asked our Italy correspondent to weigh in on. We're expecting it to come in relatively cool, actually, at 2% year on year, which after a period of like super elevated inflation, I'm thinking like in the peak it was above 6% year on year. Hitting that 2% level is like a really kind of key marker in time in how central banks are thinking about inflation. But at the same time, they have all this tariff uncertainty, and I know Trump has slightly delayed when the 50% tariff for the EU is going to come in, but it's still coming potentially. And I think we're seeing a lot of pressure on the US side to kind of have a bit more clarity about these longer term tariffs. We've had court decisions in both directions. And so I think whilst inflation is cooling, the future prospects of it are a bit uncertain. And so it'll be interesting to see where the EU data lands.
Yeah, so I think a few things that we can discuss there. Some stats for nerds, I pulled this up earlier. From a stock market perspective, June has historically been an unremarkable month. Since the Second World War, the S&P 500 has recorded an average price increase of only 0.15%.
Wow, so it's like a totally non-existent month.
It really does show that, and another stat here is that excluding June, 60% of S&P 500 increases happen outside of if you were to take June out, you would get, sorry, I'm just trying to get through the set. You would get 94% of all S&P 500 price increases happen outside of the month.
So if you were to basically sell at the end of May and then buy back on the 1st of July, you're like no worse off essentially.
Yeah,
like 94% of the changes.
This is the strategy back to the Second World War. And yeah, this is, this goes to like the Anchorman story of, 60% of the time it works every time.
Yeah, exactly. Yeah.
So that's one of the things that we are looking at. Then again, with Europe, I think what we are seeing, and obviously there's been some changes to what's happened with regards to tariffs. With the court order now coming into place, which has suspended Trump's ability to implement tariffs as a policy tool as part of his this Emergency Economic Powers Act that he's implemented. What we're seeing is that it's kind of robbed that administration from using that as a tool. So we've seen rates kind of indicate that you're going to have less inflation potentially because you've got more growth because the tariffs aren't being implemented.
And I think at the same time, you've got the fiscal stimulus that's going to come from countries like Germany spending more on defense in a way that they haven't historically. And you can see actually German bond yields have actually been increasing the last couple of weeks. And I think we're really in a mode where the market is starting to look at those longer ends of the yield curve and starting to feel a bit dicey about all the spending and kind of how it's going to get paid for, especially for the US, where like, okay, if they're not going to do these tariffs, then Trump's big, beautiful bill that involves a lot of excess spending doesn't really have anything that's going to counteract that fiscal stimulus.
Yeah, absolutely. I think going on to the Trump's big, beautiful bill, the other elements that we're seeing in the market is that there's this kind of shadow trade war that's developed. And so one thing is the tariffs, but the next thing is just simply not selling or not buying goods from certain regions. So we're seeing it, the easy view is like what's happening with China. The US are restricting technology to be sold to the Chinese, and the Chinese in turn are not selling rare earth materials to the Americans.
It's a really weird, like multi-fronted war. So you've got the kind of official policies of headline tariffs. Then you have the official policies of these kind of non-tariff barriers that you're talking about. But then you also kind of weirdly have this ground game where, so for example, there was a period of time on TikTok where manufacturers of luxury goods in China, but the luxury goods of American brands that are then sold in the US, were revealing how much some of these manufactured goods actually cost relative to the markup that they're sold at. And suddenly a bunch of consumers were furious at the fact that they were getting marked up 300-400% from very, very low costs in China. And so there's also a kind of winning hearts and minds piece of this.
Yes.
And I think in particular, one of the tariff changes that I think is non-trivial, but I think doesn't get talked about enough, is the removal of the de minimis kind of condition on tariffs, which is historically, if your goods were below a certain amount, which was typically around $200, there just wasn't a tariff applied at all on the goods. And they've removed that exemption as part of the original tariff policies. And so what that's meant is a lot of your like Shein clothes or Temu stuff, it's like suddenly that's now getting tariffed. And so, yeah, so I think there's definitely a lot of like kind of political and social pressure on both sides. And I think that kind of comes with the general slightly more isolationist positioning that we're seeing. I think on the court case stuff, it's worth just maybe like laying out the timeline for people watching, because I feel like I'm someone who consumes a ton of news, and even I feel like I'm like totally out of the loop on this, which is basically we had the original round of tariffs, a large portion of which were then paused, but some tariffs were still left in place. And then there was this huge back and forth with countries like China and with the EU on when tariffs were going to be paused until. And all of that was done, like you said, under the Emergency Powers Act, which was this act to give Trump a bit more control over the tariff policy. So now a federal court earlier this week said that actually those tariff changes weren't allowed because the power of the purse should sit with Congress. And so they can't do it under an Emergency Powers Act. They have to do it through a bill. That is quite a controversial decision, actually, because historically tariffs have sat in this kind of grey space where it's a little bit in the president's control, but also a little bit under Congress's control. And especially if it's for kind of national security reasons or resilience reasons like that. And so, okay, Trump and the Trump administration got fuming, super furious, and they went to the Court of Appeals. And the Court of Appeals has temporarily said, actually, that federal court decision, we're going to pause for now. And so now the tariffs can be implemented by Trump until there's a really clear decision either by the Court of Appeals or by the Supreme Court. But kind of the result of all of this is that we're just deep in the midst of uncertainty. And Trump was asked by a journalist.
And this is about the taco trade.
The taco trade,
yes,
yeah,
Trump
exactly.
Always chickens out. He tried to defend himself there. Didn't, you know, it was he did have to waffle a bit.
I've not seen him that angry in a while though. Like he said,
the previous time I've seen him angry was when he was questioned about the jet that's been gifted from.
That's true.
And he was fuming, and he called the journalist a jerk on just stop the press conference basically.
But I think we might crazily be in a situation where, because a journalist asked him about this taco trade, Trump always chickening out, I think he's more likely to double down on tariffs.
Exactly.
And so we're having like policy dictated by journalist questions whilst there's all this like legal uncertainty. It's like totally insane, right?
Yeah, I think maybe just for some of the viewers watching this. So the view has been that, and I think this came out from, was it the Wall Street Journal?
Yeah.
They wrote an article and they've defined this new term, taco. So Trump always chickens out. And the idea is that he starts with the high tariffs, and almost immediately, as soon as people start sort of just any form of appeasement, the tariffs drop away. And that's what we've seen. You know, he started at 145% with China. Very quickly, that's dropped away when China then had moved their reciprocal tariff down to 10% in that deal with Scott Bessent.
And I think, Martin, like when we're looking at all of these news updates, like normally we have data points that we want people to react to, but I think for the last 2 weeks, and probably for the next 2 weeks, it feels like all of the news is really just being driven by Trump headlines. And so like we can point out, like, look, next week there's going to be Dollar General and Dollar Tree doing earnings. There's Broadcom doing earnings. There's US jobs data, EU inflation data. I just don't think anyone cares compared to the noise that we're getting from the US administration and the fact that it's just a very quiet period. It's a bit of silly season, and like volatility might just be driven by the fact that people aren't trading in the volumes they normally do.
Absolutely, but one of the parts of that is that with the taco trade is that the effect of Trump's volatility is now starting to be reduced. People are starting to basically ignore what Trump is saying.
And you can actually see that in the lower implied vol, right?
Because and markets are continuing to drive higher, and you've got all of this volatility and negative speak coming from Trump. Yet markets are ignoring him, driving higher. I think the only thing that really is still making some implementation into markets are the sales into China, and we saw that with the likes of Nvidia. Excluding their lost sales to China, they mentioned cost them, I think, more than $5 billion over the last quarter. They're actually exceeding sales in other regions, so that managed to sort of still smooth over their earnings. maybe what we'll finish with is we'll just take a quick look again at the stocks that are coming out with earnings next week. We mentioned Dollar General, and what were the others?
There's Dollar General and Dollar Tree. I think that often gives you a kind of insight into the consumer class who's maybe slightly less well off. The reason I'm particularly looking at them is now a lot of people are paying back their student loans in a way they haven't historically, and so then maybe that will start to feed into how those companies think about things. Also, whether they give earnings guidance or not will also be interesting. We've seen a lot of players choose to not give earnings guidance given the uncertainty. We also have CrowdStrike. I think that's an interesting name, especially because there have been recent hacks. Even in the UK, there's a lot of companies going through hacks right now. And so seeing are people at enterprise level willing to pay for those services. And then finally, you've got Broadcom, which I think if you're looking at the kind of chip space, is always an interesting infrastructure player.
All right, great. I think that's going to be all that we have time for today. Thank you very much to our viewers. Thank you to Esau. Thank you to Angeline for joining us from Milan. We will catch up with you again on Monday.
Have a lovely weekend.